Call to order the Budget and Finance Commission meeting for January 14th, 2021. First of the year. Happy New Year, everyone.
Happy New Year.
Happy New Year.
Marnie, can we have a roll call, please?
We can. Commissioner Johnson, looks like absent. Commissioner Marin, absent. Commissioner Wynn,
Here.
Commissioner Solomon,
Here.
Commissioner Woodham,
Here.
and Chair Conroy.
Here.
Oops, Commissioner Samples isn't.
Oh, yeah. Good thing you raised your hand, Mel. We wouldn't
I
have
think I'm here.
All right. Seeing
Somebody
the
tell me
flag.
if I'm here.
I see you, Mel. All right. You can remain seated or you can stand if you prefer, but please join me with placing your hand over your heart. Ready, begin. I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all. All right. Okay. Item D, first thing, approval of the order of agenda. Would anyone like to change the order of agenda? Okay, seeing none, may I get a motion to approve the order of the agenda?
So moved.
Second.
All right, moved and seconded. We will do a roll call vote. And let's see, okay, so we'll begin with Commissioner Wynn.
Aye.
Commissioner Samples.
Aye.
Commissioner Solomon.
Aye.
And Commissioner Woodham.
Aye.
Chair votes aye as well. Thank you. Okay, moving on to item E, blue folder items. I see we received a blue folder item for item J1. Marnie, are there any other items that you're aware of that we'll be reviewing tonight not currently included in our agenda?
Nope, just the presentation for J1.
Wonderful. Seeing no additional blue items tonight, is there a motion to accept the blue folder item?
Motion to approve or accept the blue folder item.
Okay, and a second?
Second.
Second.
So, Eugene, help me out here. Would that be, is that a receive and file type thing, or just, what's the proper?
Yes, it's
Is it-
a
okay.
receive and file.
Receive and file, thank you. Okay, receive and file. Okay, a roll call vote once again, and Commissioner Wynn.
Aye.
Commissioner Samples.
Aye.
Commissioner Solomon.
Aye.
Commissioner Woodham.
Aye.
Okay, chair votes aye as well. Thank you. Okay, so that brings us to our consent calendar. Item F, there's 3 items on the consent calendar this evening. These will be approved in one motion. Would any member of the commission like to pull any consent calendar item for discussion at this time? Okay. Marnie, I had a question about the proposed May meeting on our tentative calendar. It says it's scheduled for the 27th, so towards the end of that month. I understand why the April meeting is later because it's a joint meeting, but what was the reason for having the May meeting towards the end of the month?
The proposed budget will be out by then.
All right, that makes sense. Thank you. Okay. Do we have any public comments on the consent calendar? Marnie, are you aware of anything? Anything from the public? Or Eleanor?
Sorry about that. No e-comments.
Thank you. Okay, is there a motion to approve items F1 through F3 of the consent calendar?
Motion to approve items F1 through F3 on the consent calendar.
And a second?
Second.
All right. Seeing a motion in a second, we'll do a roll call vote, beginning with Commissioner Wynn.
Aye.
Commissioner Samples.
Aye.
Commissioner Solomon.
Aye.
And Commissioner Woodham.
Aye.
All right. right, chair votes aye as well. Consent calendar items are now received and filed. Okay. Moving on to item G. I don't see that we have any excluded consent calendar items, so we'll move on to H, public participation on non-agenda items. This section is intended to provide members of the public with the opportunity commission. Each speaker will be permitted to speak only once. Written requests, including email comments, if any, will be considered first under this section. Do we have any public participation of non-agenda items tonight?
No
We have-
comments.
And we have one phone-in caller. So if you'd like to comment, you can raise your hand. And I see no raised hand.
Right,
Marty,
thank
that may be one of the Cosmod transaction folks. Who
Oh,
didn't
okay.
didn't want to come in as a panelist, without, clearing it with you. So I think that's who that might be.
Okay, cool.
Okay, wonderful. Okay. Next on our agenda are items continued from previous agendas.
None.
Well, if I may, Marnie, I would like to recall item J1, the CalPERS presentation from last month's meeting. I just have a comment on that, if I may. I learned recently that while private equities make up 8% of the investment portfolio, they account for nearly 50% of the associated admin costs, or 710 million of the 1.6 billion total. And that was considered under budget. With plans to increase private equities to 12% in the, soon of the portfolio, these fees are going to end up being more than 50% of those total associated costs. Though returns on the private equities have been very good recently, those returns are more volatile, as we saw in the presentation, and there's no indicators that they will continue to outperform. We know that over time these returns will cool off and return to the mean, at which time these larger fees will become insurmountable. Therefore, I recommend that equity management fees be a part of any negotiation by the city. Thank you. Does anyone have anything else to add to that?
I'm
Or
sorry.
yes, go ahead, Jerry.
Yeah, what was your recommendation again?
Well, I just think the fees related to the private equities, as was stated, make up a considerable portion of the fees. So basically, we're paying a lot more for those investments than other investments in the portfolio. And I think that's easier to swallow when we look at the returns on the private equities, but the fees are going to remain even if the returns on private equity don't. So I don't know to what degree those fees can be a part of any negotiation between the city and CalPERS, but if they can be, they should be, because any fee that just goes unchecked and unquestioned is subject to be large and perhaps grow. So
Yeah, we do not negotiate with PERS.
okay. Well, then I don't know where that discussion would come from, but those fees are substantial, and if we don't negotiate the fees, then somebody should on our behalf, because it's the city that will end up paying them.
Marnie, is there not a board or a group of stakeholders from around the state who meet and or weigh in on policies and procedures of the CalPERS, or is that just not beyond the
CalPERS has a
stakeholders?
board.
Yeah, it's the PERS board, but are there stakeholders? Let's say, would there be a finance director from Redondo Beach? Would they be a member of the board? Yourself, for example? Or how is that selected?
Actually, I don't remember if it's elected. No, it is I think some are elected and some are appointed.
So if we as a stakeholder with CalPERS as Redondo Beach wanted to weigh in the manner in which the chair is referring or describing the fee structure, that would be a methodology since we don't get to negotiate individually?
The
Or
only way
are
I
you
know
aware of
to-
another way that we could weigh in on that?
The only way I know of to weigh in is to speak before the board, wait, look at their agendas and wait for a time when they're discussing that topic and weigh in during basically their public participation.
But could we maybe find out, maybe this is for a later time, the agenda, how that board
Yeah,
is
it would be a
assembled?
referral if
Yeah.
we're.
How the board is assembled, and so we'd be better informed and more fluent in how to provide feedback like the chair is describing, I think. Okay, now I'll make that as a referral then at the end of the meeting.
Yeah, a couple of comments. I think it's important for us to explore how we have an input to their asset allocation. But on this particular issue, we discussed this a little at the last meeting. You've got to keep in mind that private equity and private real estate have higher fees than regular equity. But the thing that should concern us, and the thing that we look at to determine whether these fees are appropriate or there's something we can stomach, is the after fee returns. And historically, and on a historic basis and a projected basis, private equity should return somewhere between 2% and 4% more than public equities. So our concern should be after fee returns. It's unfortunate that fees are higher, but as a stakeholder, we care less about the total dollar value of those fees than we do about the return from the after fee return from those assets. So my view, and I think our view should be, as long as CalPERS can continue to show higher after fee returns, and they need to be higher by a certain amount, while we may object to fees, that's certainly not something that we would recommend they do away with.
No.
Our recommendation would be that they cut fees where possible, but it's not a sound move for us to make or any other stakeholder to make, to say that because of the higher dollar fee, we want you to get rid of private equity. But in fact, private equity is doing a good job for us.
It has been in the near term. And
It has been long term. If you go back 40 years, private equity has outperformed public equity on a long term basis, not year after year.
right, it's more volatile.
On any sort of a 5, 10, or 15-year basis, it has outperformed. It is more volatile, that's for sure. But that's why you have 12% of the portfolio in it and not 50%.
Right.
And Jerry, I agree with you, and we should be looking at all asset classes, the returns net of fees. Now, if those fees are directly tied to the returns, then that benefits us more. But I believe that that they may be charged based on the assets under management, which means
well, they are. I mean, it's
yes.
The typical fee for private equity is say 2 and 20, 2% annual fee, regardless of performance, and 20% of profits. Compare that to anywhere between 0.5% and 1% for public equity. So the fees are tremendously higher.
Yes.
But again, the returns net of fees on a long-term basis have been tremendously higher as well. So that's what we need to focus on.
It seemed to be an unwillingness or a perceived lack of competition that the CalPERS representative conveyed to us, that there was a shallow pool of these equity managers to fish into. But that kind of surprised me, Jerry. Do you think that that's based on your experience, a fair representation that there's a very narrow pool folks who would be able to perform those tasks and maybe negotiate a more preferable fee structure than the 2 and 20, or that's standard and nobody's going to go for it other than that?
I was in institutional fund management for a long time, and every year we had the same objective, and that is to cut fees on hedge funds and private equity and private real estate. And it's somewhat reduced from what it used to be. The 2 and 20 used to be standard, and now the 2 is in some cases 1 to 1.5, but the 20% hasn't been changed that much. I think the representative's characterization of there being a narrow pool of asset managers is probably incorrect. There are a bunch of people out there who do this, and the irony is that the firms historically that we as an investor would have been able to talk into lowering their fees are not necessarily the kind of managers that we want in the portfolio, because they've not provided the returns. If you look at the managers who've been willing to reduce their fees, are the new managers or those who have a bad record and can't get money. So they'll lower the fees. But the better managers, those that provide higher net of fee returns, justifiably say, no, we're not going to do that. So it's something that's worth doing, and every asset manager tries to do it. But if you go back 30, 40 years, there hasn't been a lot of movement in those fees. Yeah. So worth trying, but it's a tough job.
Yeah, I'm sure it is. I was just curious about well, I just wanted to bring up the point that as a percentage of the total fees, it made up the lion's share. And Jerry, thanks for shedding some light as to the reason why. And once again, I agree with you that it's all about return net of fees. I don't mind paying, a 50% fee if I'm still making 150% on my money every year.
Yeah, exactly.
So, okay then. Moving on. Let's see. If there's no other items from prior agenda to discuss, then we can move on to item J from this month's agenda. With the first item being J1, discussion and possible action regarding refinancing the city's CalPERS unfunded accrued liability with bonds, presented by Marnie and Mr. Cosmont.
Sure.
Yeah, this evening, Cosmont Transaction Services is with us, Larry Cosmont and Dan Massiello. So they have a real thorough presentation regarding bonding our unfunded liability. So
right.
Take it away, Larry.
Thank you.
There it is. You're all done.
Yeah, good.
All right.
Thank you. And Mr. Chairman, members of the Budget and Finance Commission, appreciate your listening to this presentation, which we think is very timely. Dan, you can move to the next page if you don't mind. But, just from our perspective, a little bit of background, the Cosmont has been working with Redondo for over 10 years on a number of economic development and transactional projects on the waterfront, including public financing of various assets. We've had a significant and very terrific relationship with the city, and certainly appreciate all of you as commissioners and volunteers. I'm a former city manager and department director for 4 different cities, and so we are very much appreciative of the effort it takes to help cities guide and go through an analysis that is a little bit complicated, especially given the economic circumstances that we all find ourselves in. Also on the call and soon to follow me in the next page or two is Dan Massiello, our Senior Vice President of Public Finance. And both Dan and I have worked in public finance for many, many years and have worked on dozens and dozens of bond transactions. And I would say we also have Shawden Sultani, who's in the YouTube audience watching in. She actually, Marnie, is not that additional caller. She's been texting me, but she is looking in and working on this with us. Just by way of introduction, I think this is timely because all of the cities, and Cosmog probably has 75 or 80 public agency clients up and down the state and in the Western United States. And we have just finished a couple of pension obligation bond refundings, if you will. And this is a very interesting time because as kind of tangential to the discussion you all were having, the performance at the CalPERS, the investment performance, I just lost my screen.
Oops, sorry.
Thank you. The investment performance has, not really been as strong and consistent as it needs to be. I think I'm on the prior page, Dan. If you don't mind getting that back, please. Thank you. And as a result, in Redondo Beach's case, the difference between their performance, the shifting in actuarial assumptions, whether it's longevity or collective bargaining results, again, lack of performance to meet the 7% benchmark that is held up as a portfolio return benchmark, has resulted in a pretty extensive, UAL, unfunded accrued liability basis of 211 million plus by 2021. I mean, that is a pretty significant number. And it's not a number, unfortunately, that's unusual. I mean, you're going to see in a couple of pages a slide that shows where the transactions are and the size of those transactions. And unfortunately, there are a number of public agencies in this position with $150 million, $200 million of UALs. And they find themselves at a point where, because of the impact of COVID-19 and the cash flow impairment that we're all experiencing as a result of diminution in sales tax and hotel tax, that it's really, an important time to consider whether or not the UAL, existing UALs should be refunded at favorable interest rates. And that's the third leg of the stool. So on one leg, you just have had the continuing evolution of the gap in UAL. And on the second level, you've got, this COVID-19 environment, which has really put pressure on cities' budgets. And now you have, as a corollary to that, and basically an economy that's being, induced or subsidized, if you will, by the federal government. We have very, very low interest rates. And the convergence of these three trends have really, made it beneficial to at least evaluate. And that's what this discussion is about, is to evaluate whether or not there's a market-based solution that could help the city align its pension payments with its current revenues. And that's what this is about. Now, this is the first step. I mean, we are just making this presentation to lay out some alternatives. And, we're not here at this point to make a specific recommendation. I think the discussion for you all tonight is from a financial policy, from a public policy perspective, is this a program at some level that the city of Redondo Beach should consider further? So next slide.
Larry, one quick question, if I could.
Sure.
That 211 million of UAL, that can occur one of two ways. Either if the investment doesn't return the actuarial assumption, or if the fund sponsor doesn't make the contributions recommended. Most of us have been on this commission for just a short period of time. Do you know how that 211 million breaks down between those two causes? Has Redondo Beach underfunded, or have they always made the actuarial recommendation?
Well, yes, some of this, it's a great question, Jerry. And if you were to look at a really detailed schedule, which ultimately we look at, what you find is these UALs are really in tranches. In other words, as performance comes in or underperformance comes in, as collective bargaining costs shift the cost of the portfolio to the city in their own account, as actuarial assumptions cause PERS to change the formula for this particular account, then you can fall behind, if you will, and then they would give you in those tranches, there might be 30 tranches over 20 years, where the city's payment structure falls behind for a convergence of all these factors, and then you're in a catch-up mode. Maybe it's a 5-year catch-up mode. Dan, I've lost the sheet again.
Yeah, I'm trying to put the, go ahead, keep going.
Yeah. So when you underwrite this, which we will do if we all decide to go forward, you will actually forensically see how the city has tried to catch up and where the, where the gaps have been over time. So that, because it is complicated in a lot of ways, it's a catch-up formula, right? It's like, here we go. So you can see, Dan, you may want to, show this for a minute and walk.
Yeah, do you see this?
Can you guys see this? Can you all see this?
Yeah.
This is the safety fund, and this is each amortization or each discrete UAL that got formed. Actually, some return excess too that they amortize as well. It's a little complicated. But what happens is that there are actually 3 reasons that the UAL could be created. It's underperformance of investments, underfunding by the agency, and assumption changes, and that is probably one of the bigger ones actually, when they expect people to live longer and things like that. And so each time something like that happens, it creates this discrete either credit balance or UAL balance, and then they're all added up, and then they're amortized over their remaining periods of life. And like again, this is just for the safety portion of it. So and then they go ahead and they project forward. We'll get into this a little bit, and then here's what the safety portion's balance is going to be at the end of this fiscal year. And that's the amount that they'll base their pension bills, they being CalPERS, that they'll send the city next year.
Right.
And this is what you have in the our valuation that you had in your agenda packet last month.
I just think it'd be helpful to know of the $211 million debt that we owe. It'd be helpful to know how much of that we can blame on CalPERS investment and how much is due to other factors. And that I understand there's a lot of other factors, but
by adding up the numbers in that table, which you have that table from last month's agenda, you could find out how much.
Yeah.
okay.
Mary, I'm sorry I wasn't here last month, but as I recall from the prior presentation from CalPERS, there are a couple of key factors. This is unfunded liability from years gone by. There were some assumptions that were made 10, 15 years ago regarding investment portfolio performance at CalPERS. And at the time, they estimated their return was going to be astronomical and what we currently recognize as unsustainable, just like the 7% that they're still resting on today. And at the same time that they were projecting those performance metrics, they recommended to all the cities that we change the retirement plan. Originally, the cap was at 20 years. They changed it to a 30-year cap and 90% of salary. And there was no reach back at that time to capture all the money that was needed to fund all those people that were 10 or 15 years in the plan. So there was no money to fund what they were talking about, only because they expected that they were going to have this phenomenal performance. And we haven't had that phenomenal performance ever since. So we're now at a point where those people have to be paid for the rest of their life. And amazingly enough, the health plans and the exercise plans that we've had, particularly in public safety, policemen and firemen are living many more years. So it's just a compounding problem, and we're stuck with it.
Right. And to Mel's point, that is why, and then you throw sort of gasoline on the fire with COVID on the other side of the equation, where your cash flow gets impacted from an operational perspective, and it really gets us to this point. And I just have to say that for the 35 years we've been doing business, we haven't really been in a rush for our cities to look at refinancing this debt. But I'm saying now, because of the convergence of these low interest rates and this escalating and cascading set of impacts on the PERS side, it really is worth a discussion. And that's why you're going to see just in a couple of slides why momentum is truly picking up on the public sector side to fund existing UALs at a cheaper cost. That's really what's going on. So let me go to the next slide, and we could pick up some speed here, but because I think you all of you clearly understand the fundamental issues, I'm going to hand this to Dan, but the reality is, you get benchmark at 7%, they underperform. You add to that, prior deficits, as Mel was saying, you add to that actuarial changes in terms of life longevity. And then, of course, inevitably at some point, from time to time, the political leaders will capitulate to additional benefits that are expensive. And all of that really just kind of works against the fundamental accounting of this liability. And then, you're put in a position where you have to report that liability on your balance sheet. It starts to have an impact on credit. And all of a sudden you're going, okay, well, if my borrowing cost 0.3 could be in the 3.25, 3.75% range for existing UALs, I'm being held accountable to, for actuarial shifts that we have no control over and a benchmark of return that doesn't get met consistently. Why wouldn't I, try and create some cost reductions and help myself protect reserves, stabilize our budget going forward? So we view this at Cosmont. Maybe I'll just keep going here for one more slide, Dan, and then you can add whatever technical detail you want. But we view this as really kind of an affirmative defense program where, we're taking action so we don't get further behind, but we're also trying to fix some current circumstances for the city that are particularly timing because we're in a crush of economic dislocation. So next slide, and I'll tell you why, Dan, if you go to the next slide.
Larry, quick question on that slide. You're 3.25 to 3.75. Are these tax exempt bonds or taxable bonds?
These are all taxable rates, and that's what I was going to show you right now on this next slide, Jerry. You can see, kind of a summary of a number of bond issues. And if you just kind of, it's a busy slide, but, from bottom to top, one way to look at it, you can see sort of the pace of financing start to pick up as interest rates started to drop and cities started to realize that this very circumstance of economic dislocation and the added costs of, the CalPERS portfolio on a local basis, you can see that there's a lot of interest in moving forward. And you can also see in the par amounts, if you will, the dollar amounts. And you can see that there's a lot at 200 million, 150, 350 in some cases. To your point, Jerry, just now, for example, the city of El Cajon just did a taxable AA rating, which would be somewhat where we would end up if we went out to the market based on our rating. Now, they did a pension obligation bond versus a lease revenue bond for refunding. We'll tell you the difference and talk about that in a minute. But their all-in taxable rate true interest cost was about 2.85, and that priced this week. So that's even...
Used to be a good tax exempt rate.
Yeah, that's even less than that 3.25, 375 range that we provided on the prior slide, but that's a this week result. I mean, we're at that point in the market where these results are rather remarkable. Just stepping back a minute to show you the level, though, I think, of confidence we have in the potential rates. We finished the City of Placentia lease revenue bonds, which is a different way to go at that same UAL refunding. And that was a much lesser credit, BBB plus. I think we were all in at 4.25, and I think that's about a 12-year, funding cycle on that UAL. So
average life.
Yeah, average life. So I mean, we are, so at one end, BBB, sort of at one bookend, at taxable 4.25, and this week's rate for El Cajon on a AA, at below 3. I'm just trying to bookend, where these are coming in at, because I think you're going to have that question. Right in the middle of that is a neighbor, Torrance, that just finished also a lease revenue bond using streets as the financial security to get the, underwriting put together. And that $350 million par amount resulted in a all-in cost, a true interest cost of 3.4. So that's right in that sweet spot that we showed you on the prior slide. And that's a very recent issuance. That's fall or 10/1 of 2020. And just to round this out, there's a lot on here, but I think you can tell two things happen here. One is that the interest is very acute because of the factors we're talking about and the amounts of money we're talking about and the immediate savings that, basically cities can can experience by, looking at this process and getting through it. And the second thing you can see is that the rate market is really supporting this conclusion because, we're getting really incredible taxable rates. So the other one that we did just a little while ago, in the middle of last year, was the city of Carson. And the city of Carson was all in at about 3.42% TIC, and that was about $105 million issuance, as I recall, 108. 108. So, we've been in this market, and it keeps getting a little bit better. And I have to say that, your staff, Marnie and Mike, have been very scrutinous about, having this conversation. But I think all of us and so have we, but all of us just got to the point where said, wow, when we saw Torrance go out on a very productive lease revenue bond, when we completed Placentia at a BBB plus and got huge 4-to-1 subscription on that issuance. I mean, the investors were knocking on the doors to get in there, and we see El Cajon's results. The timing is right for this conversation. I'm going to hand this over to Dan. But
Larry, if I could ask a quick question or two. I noticed a difference in the maturity rates. Is that a factor of pricing or size of obligation? And then, generally speaking, we'll get into this discussion in a moment. Are these typically of these representative cities are more PBOs versus lease revenue bonds, or vice versa?
So, second question first. The history has been to do these as POBs and get them validated. And then as the market evolved, and that's another reason we're here, because as the market evolved, the lease revenue bonds methodology and process started to become a bit more recognized as a very productive way to go, because you don't have to go through the 4-month court validation process that you need to when you do the POB. And then, Dan, I think the maturity schedules really depend on the obligations under the contract with PERS for each of the cities.
That's right. Generally speaking, we don't have the entire background on everybody that's issued, but they seem to be in line with what we would expect the amortization schedule to be. So when we get to the numbers for Redondo in a couple of slides, we aligned them with the anticipated that CalPERS sent to the city amortization schedule. So we didn't go any longer than the term that was laid out. And there are a couple of, just to get something on paper. And it looks very similar for the other issuers. They did the same thing. So these are all 25 years, give or take, bonds, more or less. Nobody really has a full 30-year amortization schedule out there that we've seen.
And some is
Okay, thank you.
plus 15. Yeah.
So you want me to just keep going, Larry?
Yeah, go ahead.
Yeah, so, and Larry's got it all exactly right. Just a couple of technical points I'd like to kind of hit on this slide here before we move too far forward. Make no mistake about it, the UAL is debt. It's been argued by some that, it's not a real debt. It's not a hard debt. I mean, whatever these terms might mean to you. But it is owed to CalPERS. It is an underfunded hole in the pension plan, however it got created. And they are taking the money back. They are taking it back. It's being amortized, and they are charging interest. And they're charging interest on the 19-year amortization terms, and they're charging 7%, and they're charging 7% on the 3-year amortization terms, and they're charging 7% on AA credits like Redondo, and they're charging 7% on BBB plus credits like Placentia. It's a fact. It's inescapable. It's basically, the way I like to say it, it's like when you borrow from your 401k. Nobody would really suggest to do that, at least not a competent financial advisor, in my opinion. But when you do, you have to pay yourself back with interest. Those are the tax laws. It's kind of like the city's in that position. They didn't ask to be there. They didn't do it it's not the city's fault, but there is a debt owed to the retirement fund, and it has to be paid back with interest. And so at this point, the capital markets are offering interest rates that are half of what CalPERS is charging. There are a couple of technical reasons for that. One of which has to do with the Tax Cuts and Jobs Act, where corporate tax rates were reduced. It opened up an entire different market and appetite for taxable municipal bonds. The American Recovery Act, back from the recession, that created something called Build America bonds, introduced the capital markets to taxable municipal bonds way more than used to be known. It was very kind of rare thing. Taxable muni bonds had a very unique esoteric kind of investor audience. And then Build America Bonds really opened it up and created this whole audience of people of investors that were looking for taxable bonds. And now that we have some technical factors aligning, such as the change in corporate tax rates, not to mention just a lower supply of municipal paper in general, it's really changed the appetite for municipal bonds that are taxable. And so these are performing extremely well right now. So we are seeing these rates. We believe at the moment this 3.25% is actually quite conservative. I think if we were to sell today, we would see something less than 3.25% as an all-in cost for a city like Redondo Beach.
Dan, a question. Is it just coincidental that CalPERS is financing this at the same rate as their actuarial assumption, or is that all?
That's a great point. They're actually basically you're an asset to CalPERS, right? This UAL on CalPERS balance sheet is shown as an asset. You owe them this money, right? It's a loan. So they are making their 7% return on your back. They're not going to charge you less than what they would expect to return on any other investment they have.
So but they've told us they're going to be doing another asset allocation study at the end of this year. So it's likely that 7% will be reduced to some level. When that happens, will our financing rate also be reduced?
Yes. That is the way it's been done in the past. As they reduce their discount rate, and they have, and this 7% is the culmination of a couple of years. And Marty knows this. Reduction in the rate. They've stepped it down. It was as high as 8.75% a while ago, and so they brought it down to 7%. If that 7% goes lower, what happens is, yes, your financing rate on these bonds, on the UAL, I should say, would go down. But what would happen is that your contributions for the current payroll would go up, obviously, because there's less interest earnings assumed in the way they size your bills. So they'll just shift it from the debt side to the current expense side. Any other questions? Let's move on. Larry touched on this a little before, and this question was asked. There are a couple of ways if the city decides that it wants to find a market-based solution to manage this, the type of securities that can be issued by a city like Redondo Beach. There's basically something called a pension obligation bond. And what that means is that it's a general obligation similar to as if there was a vote of the people. It is a debt that already exists and is imposed by law. Since it's never been sued and there's no precedent, the lawyers still insist that we go validate these. So we go to the court. It's totally perfunctory. I don't think one's ever been turned down. But it is a long process. And the court validates that, yep, this is a debt owed by the city, and it's an obligation imposed by law. The city may use its general obligation, its promise to repay these bonds. And the other way to go about it, which is the common way of cities doing financings, Redondo Beach did a lease revenue bond financing 2 years ago, right now, like at the anniversary of it, to refinance some property acquisitions. Is to do a lease revenue bond, and that's where the city would transmit an asset via a ground lease to I think it's called the Community Financing Authority, and then the city would lease that property back, and those rent payments are the security against the bond payment that make the bond payments out to the capital markets. So those are the two main structures. Lease revenue bonds do not require validation. You're able to issue those directly in that manner. The same program that we did in 2019 would be very applicable, and it's what your neighbor Torrance just did. Was they actually, for a lease revenue bond, there has to really be a lease. There has to be, it's recorded, it's legit, and there's an actual property involved. The question becomes, what properties do we lease? And this is a lot of money, $200 million. And so we did a $30 million deal with the city 2 years ago. We used part of Harbor Boulevard. Torrance used its streets as the underlying property. So there's precedent for it in the marketplace. And since the city has done it, that might be an avenue to consider going forward as well. So that would stay tuned. That would, take a little more analysis, but that is an opportunity that we think the city would be able to benefit from. And interestingly,
Dan, are investors just as interested in the lease revenue bonds as the regular pension obligation bonds?
I was just going to get to that, Commissioner Conroy. Oddly enough, or interestingly enough, depending on how you look at it, the lease revenue bond, the pension obligation bond, is actually just a promise. We promise we'll repay. It's a moral obligation. Technically, it's not like a voted on bond where a tax can be levied and increased as needed to make bond payments. It's just a general debt of the city. It complies with the Constitution in the terms of what the definition of debt is, whereas a lease revenue bond is a lease. It's not a debt. But there's no actual collateral or security. And those words maybe are a little bit of a misnomer. We throw those around. But that's how the market feels about it, that if a city is actually leasing a property, it feels, the market in general feels a little more warm and fuzzy, so to say, that the city would actually go ahead and make their lease payments, won't default on their rent payments. There's nothing really stopping the city from doing that with their general obligation bonds, both of which are really means just to get a city into court. If the city defaults, the investor's going to sue, and you know, if it's a GO bond, it's clear you have an absolute obligation to pay. If it's a lease revenue bond, you have to abide by the terms of your lease and make payments as well. But the investors actually like the lease revenue bond structure a little more than the pension obligation bond structure, both of which in a city with a credit rating of Redondo would both be very attractive investments to the market, though.
And Dan, you may want to cover, there's kind of a sort of a phantom preference of the market because, you know, the rating agencies would assign a higher rating to the promise, if you will, the POB, than they would to the lease revenue bond, but the investors would assign a, you know, higher level of economic interest and thus perhaps, you know, a reduced rate in terms of their investment because of the, what I call the sort of the phantom equity or the phantom security that the lease structure presents.
Yeah, that's exactly right. You know, Standard & Poor's has their kind of ratings criteria, and what they're, in a nutshell, the ratings criteria for lease paper is what they call one notch below the general obligation credit rating. So the city of Redondo Beach, we would expect would have a AA+ rating. Since there are specific risks built into lease revenue bonds in order for them to be defined as a lease, there's two main ones. One is abatement risk for the investor, meaning that if the city does not have use of the property, it may not pay rent. Just like, you know, a house or a commercial building, if you're renting it and all of a sudden it's unusable, you don't have to keep paying rent. So that has to be part of the lease. And the other is that since it's not a debt, it has to be annually appropriated. So it's not an ongoing constant obligation. There's this what's known as appropriations risk. So due to those two technical factors, S&P knocks the rating down one notch. So instead of being AA+, the city's bonds in January of 2019 were rated AA. But that implies their GO rating will be AA+.
So the interest cost would be where between these two? That's
the interesting part, is that notwithstanding that change in the rating, the investors prefer the lease revenue bond structure. So it's really hard to quantify. You know, I would dare say that the city issuing POBs versus LRBs would be a wash in terms of, you know, one paper, you know, the paper for the LRB would have a AA rating, but I think you'd get better reception versus the AA+ rating, but it doesn't have the underlying lease kind of securing the bonds. So,
yeah.
How about the, Dan, how about the soft costs between the two of them? For example, one has a validation process, the pension obligation bonds, and there might be soft costs associated with those processes versus soft costs associated with.
It's an excellent point. You know, a validation typically runs about $25,000 though. So, you know, this level, $200 million, it's not to dismiss it. It would technically be a little higher to do the validation for sure.
So there's no parallel cost structure or a greater obstacle in the way for the LRB versus the.
No, you know, actually, now that you say that, though, Commissioner, you know, ironically, we'd have to do some title work, and there's a fee for getting preliminary title reports. It's probably not quite as expensive as a validation proceeding, although we don't know if we have to do a lot of title work on a lot of different streets, and are they actually fee simple, or are there easements? And so we have to,
okay,
you know, dig into that, make sure the city actually owns them.
They could be pretty equal. I mean, maybe not quite, but you know, we when we did the LRB in Placentia, we probably spent you know, between $5,000 and $10,000, you know, $10,000 on that title and research that we had to do, maybe a little bit more. But I think the distinction though is the timing distinction, and I guess Dan, you'll get to that on this one, because the validation can take 120 days in a COVID world that's a little bit less predictable. We did get Carson's done just in the nick of time in the pre-COVID realm. We were at about March, and somehow we filed it last, I think, December, and we got the opinion like in March after COVID had broken loose. And so we were very lucky there. But there are some delays and a little bit less tangible predictability with the court validation.
Yes, your opportunity cost of the delay would certainly wash away the minor increase cost for one versus the other.
That's my point. Correct.
Exactly. As a matter of fact, since we're on this POB slide here, as I already mentioned, they're a debt in there. They record once they're validated by the court. There's actually kind of a deadline if the city wants to restructure its payments that will be due starting next year. Right near the end of June, if you don't get a payment into CalPERS, if you don't pay off your UAL, they shut down for about 6 weeks and they start to do all their math and calculations and start preparing the letters they're going to send out over the summer. You won't actually be able to repay that UAL. So there would be potential for going down the POB path if the city chooses to refinance this. That the validation might cause you not to be able to refinance your UAL in time to get ahead of the distribution of the bills for fiscal year 23, right? Yeah, the bills will come out in 21, 22 starts next year. Those bills are already out. You already know what your payments are going to be, 21, 22. Over the coming summer, they'll send you out their projections and what they're going to bill you for 22, 23. So to beat that, you need to make a payment or whatever you're going to do before the end of June. So the timing opportunity cost, as you mentioned, is absolutely something to keep an eye on. So I think we pretty much explained pension obligation bonds pretty clearly. Any questions about just the nature of that or what a pension obligation bond is specifically?
Quick question on either one of these. Because we're a charter city, do either of these require a vote, a public vote?
No, that's the part of the point of the validation. The pension obligation bond, the debt already exists. So we're asking the court, hey, court, please affirm or validate that we owe this money to CalPERS and we're going to go just change the vehicle and we're going to repay this debt. We want to save some money. And the court will say, yes, that's debt. You can incur another type of debt to refinance that. A lease revenue bond is a lease, and it specifically kind of gets around. It's a loophole you can drive a truck through, but it's the way California cities do their financings. There is no vote required to finance with general fund revenues in that regard.
So a question of this I'll wait for it on the lease revenue bonds then between the two.
Yeah.
Yeah, and so as I kind of already mentioned, so we kind of move through this kind of quickly. Lease revenue bond is actually a lease-based transaction. There has to be a property involved that will get recorded with the county clerk. The city will rent property from the community financing authority, that property that was already leased over to it from the city. So it's also known as a leaseback. And bonds are issued based on the revenue stream created from those rental payments. As mentioned, that technically the rating agencies generally rate these a notch below the general obligation rating, but the market actually prefers this structure, interestingly enough. And so the choice of properties could be whatever unencumbered assets are in the possession of the city. The city, interestingly enough, has great finances, great demographics. Doesn't have a whole lot of assets. Doesn't have too many city halls or civic centers and things like that. Certainly not $200 million worth that are unencumbered, and some of them are already used in other financings. So we would need to be a little creative. We did, in Placentia, we used their city parks. But I think since the template exists in Redondo Beach, one I think natural consideration, at least, would be the use of other streets since it's already been done and proof of concept exists. But that's a finer structuring point that would be dealt with in the process of the transaction. So a little bit about the actual UAL. Is there a question?
Yeah. Oh, go ahead, Jason.
In the list of recent issuances you showed us, roughly a quarter to a third of them look like the LRBs to me. My question
is a little
is,
less than that. Oh, no.
Okay.
Yeah.
Anyway, that was definitely in the minority column. So
it's a newer form for this UAL. Matter of fact, we kind of led the way. The structure we used in Placentia, that pledging their parks, was brand new. Nobody's done that before. For this UAL obligation. West Covina over the summer was kind of the trailblazer in terms of using their streets they were going down the PLB path, and there was a threat of a challenge, because part of the validation process is there's a 30-day challenge period after the court renders its decision. After the court issues the judgment, then there's a 30-day window where people can challenge, and there was some whispers of a challenge, and so the city pulled the plug, said, you know what, we're just going to do it this way. And that really kind of opened the, showed us the way that, hey, the market accepts this, a lot of bonds, and they did very well. What did you say it was, Larry? You have in front of you 340, I think, on that, and they're only an A+ rating.
Yep.
So my question was this: for the ones where they did the LRBs, was the main impetus that they wanted to get it done? It was time. It's almost like get it done quick, get it done now while rates are lower, almost like a rate lock, as opposed to all that market risk of waiting. Was that what drove it mostly, or was there something else?
Hard to say what those individual entities did because we didn't work with them, but I think we know for a fact we have some contacts in West Covina that the decision was the threat of a challenge.
West Covina was clearly a former Cosmont staffer, who is now an executive in their city management staff, and so we had very direct discussions. So it was clearly a strategic decision to step around a challenge. In Placentia, it was a combination of credit and the evolution of the market. We just felt that we could do better for that city using the lease revenue bond based on the underwriting that we did of the marketplace and the investor interest. So that, and really the most important thing is to note is that, and we say this earlier in the presentation, that this has really evolved. This marketplace is changing. And I would say that because of these interest rates, and I would say that in every case, when we talk to the underwriters and the investors, timing is a little bit more a sort of a creeping issue that goes into the equation. Folks are just concerned about waiting around, trying to capture the interest rate. And so timing at some levels becomes sort of an evolving and ascending consideration, I should say, in the formula or in the decision package.
Right.
Yeah, that was my thought, is because interest rates are so low right now. They really don't have anywhere to go but up. We don't know when it's going to happen, but that's probably the direction it's going to take.
Right.
So I kind of like the expediency of the LRB. And it sounds like at least so far, when you've been talking about the two different avenues, it sounds a little bit like you're kind of liking the LRBs as well. I don't know if that's in general or for us in our situation.
Well, I'm sorry, Larry, you want to take it?
Yeah, I think in your situation, it's really specific because we had a very good experience on the LRB side in Redondo Beach. We think that we're right to do it. We also, just our nature is that when you see these rates the way they are, you see the appetite in the marketplace, there is just an intuitive motivation to get it done because, things, just the way I view it is, things don't ever seem to get better, and so we just think that the timing and the expediency and the background experience of Redondo with LRBs in a prior set of issuances that we did with you and the market acceptance of all these, it's just the invitation seems to be the best one for us to take that avenue. So that's why we lean there. But we have not made the decision for sure. We're not making that recommendation. We're just being candid with you and saying that, if we had a leaning right now, it would likely be that subject to further due diligence.
Yeah, there's pros and cons to each approach. Obviously, if you lease $200 million worth of properties, you tie up $200 million worth of assets that limit your future financing potential. So it's definitely an evaluation that needs to take place. In Placentia's case, I was just going to add that, and you can see a bunch of these happen in October. What happened right after October, you might recall, we had a little election in this country. So a bunch of folks were actually interested in getting into the market as quick as possible, Placentia being one of them. So that was what really drove the LRB process for that.
Do we need an investment banker to issue these, or do you guys serve that purpose?
No, we're the municipal advisor. We would help manage the process with the investment banker, maybe more than one because it's such a large issuance.
So, okay. And the net interest cost, the total interest cost you were talking about included the fee for the investment banker?
The numbers that we've been talking about was known as the all-in true interest cost, which includes underwriting fees, correct?
Right.
All fees.
I'd like to kind of pick at this just a little bit deeper, if I can, please, Larry or Dan.
Sure.
And Larry, you made a reference to this a little bit earlier. So we issued our lease revenue bonds to consolidate as a result of some of the things that happened in the harbor. And it was about $30 million. We used lease revenue bonds for that, and we used Harbor Drive as a collateral for that transaction. We would then look to other streets and other assets within the city, such as City Hall, the libraries, things like that, in order to collateralize this obligation. Our lease revenues that we do have are pretty much in the harbor itself. And the future value of those leases over the next 50 years, absent participation, just the base rents, is about $130 million over the next 50 years. So I don't know, I'm not being as fluent as you all are, obviously, in all of this. Does that present a challenge to us with an investor that we're collateralizing, if we can come up with the $200 million in collateralized assets, and then beyond that, what our revenue streams are looking like in order to support this obligation going forward? Especially when you consider that our lease revenues are deteriorating right now with COVID and in anticipation of some renovations in the harbor.
It's actually fairly direct analysis because, first of all, don't mistake the use of the property as, literally collateralizing anything. It is creating the lease structure that enables the issuance of an obligation that won't be defined as debt. I mean, we call these bonds. I mean, they're lease revenue bonds, and we're just colloquial, but we are being precise and specific. And so, any property that the city owns that doesn't already have a lease on it, which is why streets are attractive if they're, if we, make sure the titles are clear and they're actually the city-owned streets, like Harbor Drive was. That property is transferred to the community financing authority for a nominal lease amount, and then it's leased back for the payment on the bonds. So it's just a structural maneuver. Now, if you don't pay lease payments on your bonds, there is the trustee technically has the ability to enter and relet the property. Although we left that out of the street of the deal, because how do you relet a street? And so
Right.
it was accomplished. And that was actually, it took us a while to kind of get around that and comfortable with that, long talks with the underwriter. But at the end of the day, it's the hammer that a bondholder has to take to court. If the city stops making its payments, the bondholder will sue and say, you have to make your lease payments. You can't, you're leasing these streets. And then the court, based on other precedents, would rule, we would expect that, yes, you have to make your lease payments. You can't be cute and leave them out of the budget, so to speak. The other aspect is that this will be, so that creates the legal authority to actually issue, and we'll say borrow the money. We can't tell the state we're borrowing, but you're borrowing money. That creates the legal authority to enter the markets. Now, the credit analysis doesn't have anything to do with the harbor leases or anything. It has to do with the strength of the general fund overall. And what are we doing here? What are we talking about? We're talking about reducing the stress and the pressure on the general fund by millions of dollars a year. We're actually talking about entering a financing that would lower the costs and the expenses that the general fund has to carry. So that right there is a very big credit positive, which is why part of the reason that the pension obligation bonds are viewed that way by Standard & Poor's in their analysis.
Correct. So we're
Overall revenues versus specific revenues.
right, and we're producing savings and just setting up the vehicle through the lease revenue bond to get to those savings, right?
Okay, so it's an explanation that it makes sense. It's not the moniker is a lease revenue bond, but it's not specifically tied towards the lease.
That's right. And
Not in the traditional sense that you're thinking of. Yeah,
right,
Okay,
not the
great. Thank you for explaining that.
right.
sure.
So and you're going to see, by the way, it's a perfect question because you'll see in the next couple of slides how those savings look under different repayment formulas, which we'll show you in a second here.
Okay.
Exactly. So we'll just run through this real quick. I don't want to take up too much of your time here, but we threw some big numbers around. As Moni can attest, the city's two combined major funds, the safety and the miscellaneous employees, CalPERS sent out their numbers to the city last summer, and they said at the end of this current fiscal year, this coming June, we think you'll owe us $211 million based on what's already outstanding. So you're gonna start paying that down, and in fiscal 21, you're gonna owe us. Did I put it on this page? About I think it was $13 million, which the city already paid. The city paid it in June to earn a discount. But that number is actually derived from what the balance was at the end of 2019, 2 years ago, and they project forward, and they come up with this number, and they say this is what you owe us. So here's kind of the math. This is kind of the value. So what they do is they say, hey, the actuaries say you have these obligations over time to these people, and you should have $600 million, almost $613 million in your market basket, in your portfolio. You only have 404. Not because of anything the city did. As you know, the city makes payments on time. It's because of underperformance of CalPERS and assumption changes over time. Yeah, it's right here, big bold letters. So the city made the 2021 payment that's already been made was $13.7 million. And next year it's already scheduled. It's on the schedule. It's going to happen. It's a fact of $15.5 million. That's a 13.6% increase just that you're going to be seeing in next year's budget. And over the next 10 years, that number is closer to 60%. I think I covered that in the next slide. So with no other changes, we already know that UAL is going to go up because while it should be paid down slightly, we know that in 2020, the year that just ended, CalPERS posted a preliminary earnings of 4.7%. So at least they were in the black, but they needed to hit 7%. So that's a new UAL coming your way. So let's talk about the savings a little bit. So like we said, it's the city's repaying this debt to CalPERS. We're going to see payments, the city will see payments hit a high in fiscal year ending 2031 that are 58.6 higher than they are this current year. That's a very, very steep increase. Market-based rates are extremely low right now for many technical factors that we covered before. And we calculate based on certain assumptions we use that, the budgetary savings in an absolute dollar value could be anywhere from $50 million to almost $90 million. It's just an astronomical number that really is at least worth consideration. So how did we come up with that number? This is one of my favorite slides. So this blue line is the current amortization schedule provided by CalPERS, determined by CalPERS, that the city is going to be repaying on its two funds. We just took that amount owed, and here are all the payments scheduled, and we just refinanced it at current rates and made it look more like a mortgage. Nice level payments. Let's pay off the amount we owe over the next, in this case, it's 28 years, based on, again, what the assumed repayment term that CalPERS has amortized your balances over. This results in a couple of things. One, present value, they're all about the same, $56 million. This results in the lower of the absolute budgetary savings, but what it does is it really frees up a bunch of budgetary savings over the next 10 years. $3 million next year alone, $4.5 million the year after, 5.5, 6.8, 6.4, almost 7 in the next several years. That's real money. That's not going to be spent in the budget on paying this obligation. And as you can see, it actually reduces the budget line. The negative of this slide, and we go into some of the pros and cons here of this approach, so some of the pros is it generates the most upfront savings, near midterm budget relief. I like the fact from a budgeting standpoint. When I first started in this business in the early 90s, a smart budget manager for a large county I started in New York, he told me one day, I was telling him, I just learned about how to do bond analyses, present value, and comparing present value is really the only way to do apples to apples. But, he just stopped me and said, hey, listen, Dan, I can't budget a present value dollar. So it just kind of stuck with me ever since. In cities, the cash flow really is the fuel that drives the services. And, while present value enables us to make some apples to apples comparisons to make things on a level mathematical footing, what's really important is establishing that budget line. You put that budget line in at $12 million, and we know that this huge UAL, this huge debt of $212 million will be paid off at a point certain, at a level certain, and it's predictable. So other UALs may come, and we'll get into that in a second, but we know that this large chunk is not going to change. That's the other problem with this, is that this blue line here changes every year. CalPERS recalculates this amortization every year, and it changes. So the negatives of doing it this way is, I think it's the obvious, is you're putting debt in years where there was no or not many payments. Some people don't like that. These are your cheaper dollars, of course. These dollars cost a lot less. So it makes some sense to use them over there. But politically, policy-wise, that is, something to be considered.
Dan,
Yes, sir.
looking at this table, what's your amortization schedule? This extends out to 2049. That's 27 years out.
Yep, that matches the CalPERS amortization schedule.
Okay, so based on this chart, what you're saying is that 2049, this $12 million a year goes away at the same time our CalPERS obligation goes away.
This particular part of it, like as it exists today, as we try to kind of say, it's a dynamic thing. CalPERS will have a new UAL, and you'll learn about it next summer. How much did they lose for you or not perform for you last summer? Right. Last fiscal year. But that will end up being another payment on its own. But one way to kind of address those coming is to create some room in the budget. But yeah, all we're doing here, and this is, by the way,
current assumptions.
For illustrative purposes, these are establishing some benchmarks to have discussions. These are totally customizable. We can make them shorter. We can make them longer if you want to. We wouldn't necessarily recommend that, but those are options. And we're going to get into a couple of those structures in a minute. Yeah. But the basis of all of these presentations is the current term that the amortization of the current UAL will end as it existed last summer, letter dated July 2020.
And we think that these assumptions are probably going to increase based on the quadrennial reset.
Yeah. Well, I think that the CalPERS repayment will definitely increase. This is another analysis we performed, just again, kind of for the academic exercise. This seeks to mimic the current repayment structure. Excuse me, just reduce it. We would call it level savings, but I don't like this one so much because, again, this blue line will be a different blue line next year. But and as far as taking a snapshot of point in time, this gives you some immediate budget relief, but you're still faced with budget increases. So the current line was about $13.5 million. So by fiscal 23, you're going to be greater than that. 24, 25, you're still going up. You're just not going up as much. But it doesn't create those negative savings in the out years. It doesn't add debt to where there wasn't debt before. And so your gross dollars, this is the most lucrative or highest yielding in terms of actual absolute dollars. But the present value is actually less than the previous one. This is $56 million, almost $57 million, 55, almost 56. This one was 56, almost 57, because your savings are greatest in the out years when the dollars are worth less. So some pros and cons to this schedule, as I just mentioned, a few that this produces the most absolute dollars over time, and it repays the overall liability in the shortest time frame, which again, kind of policy-wise, that's something that might be a consideration. But it's not an accurate comparison, because the schedule of the UALs changes, and so it's a snapshot, it's a point in time, it's not an ongoing dynamic comparison, and it still does require those steep budget increases. This is the way Placentia did their bonds. When they refinanced their POB, or their UAL, I should say, they went ahead and chose this sort of schedule. This is kind of what we call a hybrid. And as you can see, what it does is it chops off that mountaintop, which is really, I think, a big part of the goal. It does represent a slight increase over fiscal 21's payment of about $13.5 million, but it is less than the scheduled payment coming up for fiscal 22. It keeps that line item in the budget consistent. And then as the UAL, as it exists right now, was scheduled to start declining, the bond payments decline as well, and it mimics that. And so this achieves a couple of things. This has, again, $56 million, about the same present value. This is a little less, $10 million less over time, but it does produce quite a lot of budgetary savings over time. So again, as I mentioned, it does establish a permanent level repayment with no future increases, and it doesn't add debt in the years where there wasn't debt previously, in case that's an important consideration. It's sort of a balance between the two approaches. But again, it's not the most accurate because the blue line will change. It does increase the budget between this year and next year. You still have to step up about $1 million. And it doesn't really maximize, these green bars are a lot higher here than they were in the first one. So let's just stop there real quick and see if there's any questions about that.
You say it steps up, but compared to the UAL, the scheduled UAL payment, it's still a reduction from that. Am I reading that correctly?
That's correct. That's right. So it goes up. So it's what's not on this chart is what the payment in 2021, the current year was, and that was $13.5 million. So it was right about here. So you'll have
it's marginally higher, but comparatively, it's still lower than what it would be under the other.
Oh yeah, it really chops off the top of that mountain of the increases coming.
Yeah.
You know, Larry and I have been looking at a lot of cities, and Redondo has one of the worst, slopes of its pending amortization than any we've seen. It's 60% increase over the 59 over the next 10 years. That's one of the highest we've seen for sure.
And I would call that a best case scenario,
Right.
based on the fact that they're going to bring down that.
Not going to get better from here. That's right.
Right.
Yeah.
Absolutely
And it starts immediately. You already know that you're in for another hit, right? Based on the current numbers. So.
Mm-hmm.
right.
So,
So
Dan, just looking at your first chart, is there anything that would prevent us from being 15 years into this or 18 years into it, and for some reason the city comes into a windfall of cash that we could either refinance this debt or pay it off early?
that's a great question, and that's one of the things that when people look up pension obligation bonds, one of the knocks on, or one of the negatives people say that's out there in the world, and the internet doesn't always refresh very quickly, is that, oh, you're going to issue non-callable debt. Well, 15 years ago, that was the case. Like I was saying, before Build America bonds came about, whenever there was a taxable municipal bond, the common typical structure, in order to find anybody to buy it, was they were issued as non-callable bonds. You sold the bond, that's it. You're making the payments until it matures. These bonds, we haven't gotten this far down the road, but the standard structure is that they are callable after 10 years, and generally at par, without premium, no penalty. You're not allowed to repay them before 10 years. The investors guaranteed 10 years of fixed income, but after 10 years, the city may go ahead and call them in. So that creates a couple of dynamics. One, whenever that windfall occurs, if they're not callable yet, you could set up an escrow and mathematically determine if it makes sense to actually call them when they mature and let the escrow take care of the payments. Or after that 10-year mark, you can go ahead and call them in. So we sell these bonds. These would be sold with a call option. That's the city's call option to exercise.
Okay, thank you.
So a couple technical points. I know that Marnie and I had spoken about this over time. One of the questions people ask is, well, what happens if CalPERS all of a sudden starts, performing like crazy, the 18, 25% returns, and we just paid them back? We're not giving them the chance to kind of earn their way out of the UAL. They haven't really done that yet, but they certainly could. So one, like I was saying earlier, these are completely customizable. The $212 million number is post. That's the max. That's the limit. That's everything. If you want to wipe the slate clean, but maybe it makes some sense to leave some money in CalPERS' hands. Maybe it makes some sense to only be 90% funded and leave that 10% unfunded in their hands and give them a chance to earn their way out of it. That's something we can analyze and have a consideration. Another consideration, another option was the lease revenue bond that we talked about. With the lease revenue bond, since it's not the court validation, the validation process asks the court to validate the fact that there is a debt existing and outstanding that is already imposed by law. If it's a lease revenue bond, it can be whatever you want. And since it's taxable, it's considered working capital. You can borrow as much as you want, as much as the market will let you. So what we did with Placentia, we actually went ahead and pre-funded. They set up a Section 115 trust, which is a means to manage pension payments, among other things. And we pre-funded, we borrowed a little more than their UAL. We borrowed the amount that we anticipated the 2020 UAL will be creating. In their case, I think it was $2.2 million.
Right.
So, they're about a quarter of your size. UAL, right? So if you just extrapolate from that, I guess you could probably expect, $8 million more coming on UAL. If you do the lease revenue bond approach, not only is it quicker, you could choose to not only pay 100%, you could pay more than 100% and prepare for that next UAL that's coming. And as an option, again, consideration. We should do the math. We should have all the variables. And again, as I did this kind of backwards this page. We could, of course, refinance all the UAL anywhere in between those marks, and we can repay it at the current term. We can repay it longer if you want. We don't really see that happen too often. We can repay it over a shorter term. We've done that with a small district we worked with up in Northern California. They chose to, instead of 25 years, they chose to do a 20-year repayment. So there's all sorts of options that can be evaluated. So Larry, you want us to kind of take it home from here?
Sure. So we've given you an awful lot of information, and again, really appreciate your patience. But I think what we started to say in the beginnings really it resonates. I would hope with all of you, and that is we can refinance the UAL. The market is very appealing to do that. We have a couple of ways to go in terms of a process: POV versus LRB, and there's timing and sizing considerations for sure. We can customize the repayment structure, and I think that's attractive for us to look at, especially if we want to hedge against future performance, better performance for CalPERS. We could look to reduce what we fund and not fund 100%. And then we hadn't talked about this much, but most of the cities that we're working with, they take the savings and put a portion of them into this Section 115 trust where they can basically have specific goals and objectives for the savings and any economic or interest returns from those savings from, follow-on investment. And those could be also collaterally scheduled to meet operational costs as well as economic development projects, whatever the body politic or the leadership wants to do. But it's a very responsible way of controlling the benefit that you've created by essentially funding at a lower cost, this very large obligation. So next slide. So the primary considerations here are very fundamental. You can reduce the cost of the debt. It's pretty simple. And basically you can manage the predictability of the payment, which is rather, sort of, instead of being on sort of the unpredictable, a little bit roller coaster that mostly moves up, not down with CalPERS. And because of that, the city can, Marnie and Mike Witsansky and Joe and all of you can start to look at managing your, the rest of your budget costs and not be exposed to spikes as much. And so I think that's helpful. And, at the end of the day is, one of the decision points you're going to make is if you want to hedge against CalPERS performance and sort of play with their money instead of yours, you can leave some of, you can not put everything out there in a financing and hedge it by reducing the financing a bit. And basically, I think that from our perspective, CalPERS historical 20-year returns are 5.8%, their 30 returns are 8.1%. So, my sense is that what we're really trying to do here is simply capture a very large obligation, take advantage of the immediate savings, with the understanding that, the cost of that savings should be, supported by the ultimate historic returns that CalPERS has made.
If I could jump in there, one of the reasons we kind of put these discussions on here is that one of the downside risks, if you will, is that, you're going into the pool paying interest on your investment. The money that you send to CalPERS from your current salary is 0% money, right? It's budget money, it's current funds. You're not paying interest on it. You're going to give CalPERS $200 million, whatever the number is, and that will cost you, let's call it 3.5%. So CalPERS, by comparison, will have to earn a return of 3.5% or greater in order for that to kind of pay off. And the only way to know that is when you look back at the end of the refinancing term, did CalPERS hit that mark or not? And so the question is, can CalPERS generate returns that are greater than 3.5%? Well, as much as we like to knock CalPERS, Their 20-year and 30-year returns are substantially above that number. There's nothing to indicate that over the long term they wouldn't at least achieve that. Although we can't guarantee that, of course. But it's still, regardless of that metric, of that measurement that might take place in 25 years, it would give you immediate budgetary relief now, without a doubt. You recognize those savings and you enjoy the utilization of that cash flow in the next 10 years that you will not have if you don't, if this loan isn't restructured.
When you, and in reality, when you look at these historical averages over 20 years and 30 years, doesn't that take into account the wild investments that they made during the dot-com bubble, which created this mess in the first place?
It's that and the huge losses. These are CalPERS numbers on their website. I don't know that their methodology is any different than averaging them, but
what's
it does.
What's the 5 and 7 year returns that they're getting?
I have to look it up. I don't have it right in front of me,
Okay.
but they're all positive and they are all above 3.5%.
Okay.
Well, their 5-year return that they gave us at the last meeting was 6.3%.
There you go.
4.7 for 1, 6.3 for 5, and 8.5 for 10.
Okay.
Jerry, was that before or after fees?
Well, we had some discussion about that at the last meeting. They say it's net of fees, but then later on they say it's gross of admin fees.
Yeah.
That's not nearly as large as management fees, but it could be significant.
Right.
So I think the important thing is, in reality, they have to make 7% just in order to keep our UAL from increasing dramatically every year. And the big question we have to ask is, in some reasonable foreseeable future, are they going to be able to come up with 7% consistently year over year? And they are now constrained in ways that 20 and 30 years ago, they weren't constrained. They have very similar investment criteria to what we have as a city.
Mm-hmm.
Great.
Yeah,
No
Jerry, if
tobacco.
I remember that email correctly, CalPERS expenses were $1.6 billion. And of that $1.6 billion, $717 million were the management fees for the equity portion only.
Got it.
Right.
And one of the clumsy things going forward on this is if they don't make their 7, then that creates an additional liability that we're not focusing on right now. So we based on what you can read the tea leaves, and everyone has a different estimate of what returns could be for an institutional investor. I think, let's say if it's challenging, if they don't make the 7, then we've got a new liability building each year that
Correct.
we're going to have to worry about as well.
Yes. Yeah.
That
All
would-
this does is fix your current ailment. It doesn't, it's not prescriptive. It really isn't.
So,
The distinction there is that if this new UAL that's coming down the pike, for example, that's going to increase that blue line, right? That this line's going up. It's going up. But if the city refinances it, there'll be a new blue line, but it'll just be right above this line here. So your total cost will be more, without a doubt. Your total pension costs, repayment of debt associated with underperforming pensions will be greater than these numbers, but will it be here or will it be here?
Well, as I recall, their recasting of their debt is typically 2 years in arrears. So
Exactly.
if they performed at the market for this year, we won't see how much they were under the 7% number until 2 years from now.
You know what? You're right, and I might have misspoken before. The 2019 return was positive. I think it was 6.7. Well, no, wait a minute. It was 6.7. They didn't hit their 7, so there'll be a small UAL with 2019, or is it 7.6? But the 2020 return will manifest itself you'll get that
22.
letter in the summer of 2022 for the 23-24 year.
Right.
Correct.
Yeah.
Hey, Larry, quick question on the amortization that you all did. It was my understanding that if we prepay whatever amount we prepay, there's a 3.5% reduction based on that. Does that apply to this entire $213 million if we prepay it?
Yeah.
I think it's,
So that's a good technical point. This assumes, because that's the way CalPERS prepares the numbers, monthly payments every year. So this blue line might actually be a little bit lower for you if you because you prepay it in June by 3%.
Right.
But the only math they give us is these numbers right here. Oh, here, I'm pointing at the wrong screen. These numbers right here are 12 monthly payments every year. So the city actually next year wouldn't pay 15.5, it would pay 3% less because you're going to pre-fund it if you continue your pattern. So,
which would drop the blue line accordingly. Correct.
yeah, by 3%.
But not significantly.
No.
One of the big arguments for this or against doing something like this is you don't want to take on debt to pay debt. That's really the loudest ringing bell, and I think you guys have done a good job of laying out some different reasons why you might do something like that. Based for anything from the predictable payment schedule to recognizing immediate savings and some of the other things that you pointed out. When you're choosing between the pension obligation bonds and the lease revenue bonds, Manhattan Beach, and I don't know if you all work with them or not,
Yes.
the pension obligation route. Do you have any insight as to why they chose that over a lease revenue bond, or why you think? I realize cities are different, their financing sources are different, their available resources are different, but just a 10,000-foot look at that.
We went in to see them and had a very similar discussion, and I just think the preference of the city, a philosophical preference, was not to encumber assets, but to, even though I think that these are phantom encumbrances, as we were talking about, it's still sort of almost a philosophical mindset. That's my sense of where the treasurer might have been, and Bruce Moe. I think there was a little bit, they were leaning in that way, but I had a very early discussion. I'm a resident of Manhattan Beach, so I always just sort of serve them as a volunteer. So it's a discussion that we had to go in and say, look, at some point, even though you have significant reserves as a city, you may want to get ahead of this curve because it's only going to get worse. And I think that helped them get to a point where they, went out, took a look at it, hired their own team, and basically came to the conclusion that they wanted to do the PLB versus the LRB. And so I'm only speculating that they may just have a perspective that they didn't want to encumber, or even on a faux basis, if you will, encumber any assets. So. Okay, and thank you. One more question, please. Can you elaborate a little bit on the section 115, where you talk about having funds that you might otherwise be able to set aside for, say, city infrastructure? We've got a lot of older plant in our city. We need a lot of upgrades, especially when you look at our civic center. Yep. And we're always wondering where we're going to come up with the money for that, yep, or how we're ever going to come up with the money for that. So if you can elaborate, it might be something that's not on point, but tangential to the bigger picture from a policy standpoint. Dan, you want to talk about that a little bit?
Well, Section 115 is just like saying 401k. It's a designation of the IRS code. It just recognizes the fact that the city is a tax exempt entity, and that it could have this fund and manage it, and able to have investment returns accrue in it. I'm not as familiar, maybe Larry knows a little more about this, if there's a distinction between what the expenditures from that fund can be, but what it is commonly used for is to manage pension benefits and other post-employment benefits. Right. The OPEB aspect is the most popular because there is no structure whatsoever. It's whatever your contracts are, and I'm not sure what Redondo's circumstance is, but a lot of cities have just have these kind of open-ended. As long as the employees are alive, they're going to pay their medical insurance for them, and that sort of thing, which is becoming unmanageable as well. So cities have set up this fund to essentially do what CalPERS tries to do on a more of a micro scale. It's trying to be a fund manager, and there's services that are provided, because most cities don't have sophisticated treasury management on this level. So ironically enough, PERS offers I just find this it makes me laugh every time I say it, but PERS has a 115 trust program. So you can you can fund a 115 trust to manage the UAL that PERS created for you. So I don't know if you want to use them as a service
we
provider.
have an asset management team that we've engaged. Our city treasurer is not the same as, say, what Manhattan Beach does. Tim manages their money or works that way, but we have a management a company that we hired to do that. So they would set up a fund like you're describing.
Yes.
And
And Gene, the policy is really up to the city. I don't think, typically because you're in the pension realm, you end up using these savings and any returns from the savings for corollary type expenditures like OPEBs. I mean, there's a logical nexus to do that on a policy basis, but there's not a limitation for that. I mean, you could take those savings and put them elsewhere. So
and thanks, Larry, because that's really the essence of the question, is that if you're looking for a tangential benefit, that these funds don't necessarily have to be earmarked towards, say, OPEB, but could be used for other citywide needs like infrastructure.
yeah, as far as I know, that is absolutely correct. And some of the communities don't even do the 115. They just sort of, lock in the funds and start going down their merry way. That's correct.
Okay, I just think that could help as a selling point.
Yeah, and in the case in Redondo's case, I think it's an interesting case study for this level debt service structure here, where you actually create. We're projecting a $12.5 million bond payment, where in this current fiscal year it was $13.5. That's $1 million of savings. You already have the $13.5 million line item in your budget. There's $1 million in direct savings. Maybe that's what starts flowing into 115. It's a policy consideration for the city council in general, but there could actually be some seed money right there. We're going to keep budgeting $13.5 million, but we're going to realize the savings and we're going to set it aside to make sure that we can deal with that new UAL that's coming down the block, for sure. And what are those amortization payments going to be? They probably won't be $1 million. It's an $8 million UAL. It's not going to be $1 million a year amortization, but it'll be something more. So, for example, that's one way to approach it.
Okay.
And of course, as I was mentioning, other city projects and programs.
Okay, thank you.
Yeah, and so just
Dan?
go ahead. Another question. Go ahead.
Yes.
Yeah, real quick, going back to that chart you were just on. So you mentioned that one kind of hedge would be to fund it at less than 100%, and then kind of roll the dice that based on CalPERS history that they may outperform, and that could benefit us. Wouldn't another way to hedge be to fund it at 100%, knowing that based on the CalPERS UAL payment schedule there, that at least for the next 10 years, that's going to be increasing. This debt's not going to cover any of that future increase, and then we'd be using CalPERS investments for that portion.
If I was on your city council, that's probably what my vote would be. But Larry and I have been out there in the world discussing these, and all sorts of different people have all sorts of different opinions. And what we've tried to do is kind of present both sides of this and some of the pushback that we've heard, some of the more the reasons why people don't think it's the way to go. And one of those reasons was that reason, and I didn't really get into the detail. The other half of that discussion is this: you pay off 100% of your UAL, CalPERS outperforms, and you become superfunded or overfunded. I don't know if you're aware of this. Back in the 90s, when the tech market was just going gangbusters, we had the tech bubble, the beginning of the real estate bubble. Pension plans were overfunded, as all around the state. And CalPERS started granting what they called pension holidays, that there were actual just entire payments skipped. You're overfunded. You don't have to make any pension payments this year, including your, current, against your current payroll. And so that was kind of a means to almost withdraw or give a break to cities. Well, because of the performance, that happened in the Great Recession, and cities were, if they've been paying those payments all along, the great hit that CalPERS took, they probably, UALs wouldn't be where they are today. So they did away with that. So if you end up being in a 110, 120% funding situation, you don't have any means to get that money out. Now, long term, maybe that's a good thing. Some cities prefer that. I don't know. Redondo might prefer that. It's a very conservative approach. I'm sure that your cops and firemen would love that there's more money available to them than they need. But, again, a policy discussion. a question to evaluate, where is the best way, what is the best way to manage these public resources going forward. But I tend to agree with you, Commissioner, in terms of, let's wipe the slate clean. We know for a fact, we have some information that there will be a UAL coming, that in the near term, the next couple of years, that overfunding potential isn't really there. And then to the extent that's a problem, that's not for me to decide for you, but that's a discussion that should be had.
Yeah. I mean, your dramatic 10-year spike really sets up, being aggressive, I think, at one level there. So I think it's a fair discussion, but you've got a pattern that really wants you to wipe this out as much as you can, it's because of the early spike.
So let me be sure that I understand this. When we're talking about UAL, we're talking about the unfunded liability from prior years. Our current pension payments are covering the bill, and they are covering all of the liabilities associated with existing employees. This is really encumbered from, well, either extremely long tenure employees or people that are already retired, correct?
Well,
yeah, go ahead, Dan.
Yeah, so you get your bill from CalPERS every year,
right?
And Marnie diligently pays it. The bill that CalPERS sends you is calculated based upon an assumed 7% return. So notwithstanding the payments on the UAL, just the current contributions for your workforce.
Okay.
They calculate the amount you have to pay in order to be current, to put the proper amount aside for retirement for these people. They already baked in their assumptions that they're going to make 7%. And so that bill ends up being sized as if a return happened. When they don't hit 7%, the city did not make enough of a payment against current payroll through no fault of its own. It's just that's what CalPERS said to pay, and it wasn't enough because retroactively they didn't hit their mark. That is what creates UALs and assumption changes, like when they said that they're seeing people live longer, so therefore benefit requirements are going to be greater, and those change the actuarial assumptions, and then all of a sudden when you needed $580 million in market value and it just changes overnight to $600 million just because people are living to 82 now, not 80 anymore, whatever the numbers are. Those are the two main components that drive UALs. And so your question was about, is the city actually making its current payments? Well, it can only pay what it's asked to pay, right? Right. It pays its bill, but sometimes the bill is too small, and they don't know it's too small until after 2 years later.
Okay, but these numbers, the big numbers that we're dealing with here, are related to very long tenure, traditional pension plan employees, not the newer employees that are coming in.
Oh, I'm sorry.
Because those calculations are much cleaner, correct?
Yeah.
You have PEPRA in place, right? So this actually, by bringing back to the other commissioner's point before, paying this off, you have a less likelihood of these big UALs coming online in the future, because as the new employees kind of start to make up more of your composition, the PEPRA employees, the way that's managed doesn't really lend to the creation of UALs based on them, right? So the longer term employees that are pre-PEPRA, classic employees, I think is what they're called. Their plan is that's what we're talking about here. The PEPRA employees plan doesn't have a UAL. It's a couple $1,000s if there's any, and it's extremely manageable.
Yeah,
more PEPRA employees.
Yeah, PEPRA's turning the line down in about 12 years.
Yeah.
That's what we're seeing.
Yeah, as your PEPRA matriculates into the system, the blue line becomes more forgiving for you. That's correct.
I would just speculate, though, that your CapEx in a scenario like that is that even with PEPRA employees, they're going to be receiving raises, even though our contributions are lower. The cost of living associated with that, you're going to still be contributing perhaps a higher number or an equal number, even with a lower contribution rate.
Right. Yes. But this is, as the one commissioner is pointing out, this really is sort of the big meal, the elephant ate or the snake ate. You're trying to really fix that for now and control that cost at a reduced cost of carry.
Anything else?
So
turn it back over to Mr. Cosmont to kind of wrap it up.
So we have covered just about everything on this page, so I won't spend any time other than, we are looking at that a significant rise in your case, bullet 3. And that's what we're really trying to figure out, if this makes sense to control through a reduced interest rate cost rather than further erode the city's financial position, particularly since it's strained at this point, particularly. So the timing for this discussion, as I said, going in is early and is very timely. And it's not a small amount of money that, with the rates, as low as they are, there's between this 50 million and essentially 90 million in long-term pension cost reductions, depending on how we structure it. We have good access to the market. We've talked about that. If you, and because of that, as you saw on the chart, there's an ongoing interest and focus by other cities. You're not in this alone. I mean, everyone's looking at this, not everyone, but lots of cities are looking at this because of the pressing need. So just in terms of a next step, because I think this has been a really great, robust discussion. I mean, there's no real decision being made here, and there's certainly, no specific advice that we're conferring yet. I mean, it's the discussion is, look, if the Budget and Finance Commission thinks that it's meritorious to continue evaluating a UAL refinancing, then they ought to let, I think, the council know that. And their decision, if they agreed with you and when they looked at some of this material and got input from you, which is what they look to you for, would be to turn around and then retain the advisory team, the legal team, and start figuring out with you and staff, what should what process do we go down? Is it the validation process with the POB? Is it the LRB program? What's the timeline? And commence all those evaluative activities so we can, get to the market with a determination that we're comfortable with.
Larry, we know timeline on validation for the pension obligation bonds are 4 months just for the validation. So 0 to 100 on the lease revenue bonds, is it typically, I know it might be hard to say, and just tell me if that is the case. Is it a 3-month window, a 6-month window, a 9-month? Is it something that it's similar to, you can do it fairly quickly if you get the right circumstances all put together?
Yes. Yeah, we went pretty quickly, Dan, on Placentia.
Don't tell them that. No.
Yeah, I know.
It's just, I had less gray hair over the summer.
Yeah, I mean,
good.
all in, when you're looking at the pre-evaluation period and under the POB program and the 4-month validation, I mean, some of these activities are concurrent as because you're going to set out the validation, because that's a transactional question. You're just asking the court to validate. And as Dan said, there's never been an adverse decision on that. You're just declaring it as debt and making that certifying the debt essentially. But, but you're going to be in there that 4-month window, and you've got a little bit of time ahead of that before you get your validation proceeding filed. So call it a 5-month window. You don't have that in the POB. And so you can really, depending on how quickly we can dialogue on all the nuances of, 100%, 90%, and 10-year call, all of the things that we want to look at, the 115 trust issue, we could still be done with all of that in 75 days if you really wanted to green light from the time you green light the LRB. So it's a lot less. I mean, it's really quite more efficient.
Yeah, that's right. I'd like to answer that question by saying, from the time we're given a definitive go, it's pretty reasonable, assuming no title issues, no weird little kind of slowdowns.
Right. 90
days. 3 months is a comfortable, not slow pace. 90 to 120 is pretty standard. From, again, you want to do this, it's a go, it's a deal. Got the legal team on board, get draft documents out, circulating, credit rating presentations, access the market, all that's approvals, all that sort of stuff. It's 90 to 120 days is pretty standard. Can be less. Like Larry was alluding, Placentia had a goal. They really wanted to price before the election. And we had our final green light go was September 2, I think it was. We had a presentation and we were priced by the end of October and closed by mid-November. So that was...
we have an election here on March 2nd. So that might, from a policy standpoint, complicate things a little bit.
Sure, understandable. Yeah.
So lease revenue bonds, 90 to 120 days. If we do a POB, 120 to,
Really about 6 months. I mean, Carson was about a 6-month run for us.
Yeah, if you want to try and get that UAL financed by before CalPERS, comes out with its new, before the end of June. If the bogey is the end of June, I don't know that pension obligation bonds will get you there.
Right.
Doesn't mean you can't do it in August. It's not the end of the world. You make one monthly payment, then you pay it off. But the problem is that you need to know the actual amount of debt to go to the court with. And so if that changes, you have a different process. So it becomes a little more complicated.
Right.
So the reality is, in order to have check in hand and be ready to send it to CalPERS by the end of June, this actually has to be on the council agenda sometime in February, because it'll take the council at least 2 meetings to hear it, discuss it, make a decision.
Yeah.
And that only gives you a little over 90 days to actually get the work done.
So what I would suggest, what I think would happen was, we have, this presentation to council would be sooner than later. And then, a general direction to staff. Doesn't have to be an action item. Yes, we want to pursue this. We want to put the transaction together, and then the transaction team comes back for the action item after that process is done. If the council is, motivated to do that.
And you could do that concurrently with our community financing authority, those council meetings. And Larry, would you have to present to community financing authority and the council, or how that process would work?
Well, no, for the lease documentation, clearly you have to have an agendized item for the CFA, correct?
Yeah, but as you said, it'll be concurrent.
It'll be concurrent, yeah,
Yeah, you could do that all at the same meeting, as it were.
correct.
Exactly.
Okay.
I would encourage the council members to watch a replay of the demonstration, the presentation you gave us here tonight. I think it was an excellent presentation.
Thank you.
I'll say, I mean, this, in my opinion, is even better than I was hoping it would be. I'm kind of partial to that hybrid method myself. I like how it seems to maximize total savings and also doesn't get you in a spot which may be unpalatable for some, where you've got debt, in excess, and you're actually you're not saving in the far out years. So I really like that particular one. And I'll tell you, I mean, I'm not aware of too many other things that are in the city's budget that have 50 to, what would you say, $90 million savings over the next 30 years or so. So
Yeah.
to me, it's just fantastic.
You got a lot of expenses coming that seem to be able to be knocked way down. Yeah, absolutely.
Okay.
Well, thank you, guys. This has been a really informative and a great presentation.
Well, thank you.
Thank you for your time. Happy to do it.
All right. Thank you very much. Seeing no other comments from any other commissioners or questions. Thanks so much.
Okay. Bye
Okay.
now.
Bye,
Bye-bye.
see you guys.
Thank you.
Bye-bye.
All right. Now, Marnie, had you ever worked with those guys in the past or dealt with them?
Yes, we
Okay.
worked with them on our last bond issue.
Wonderful. All right. So we're familiar with them. They're familiar with us.
Yeah, and I'm sure you're familiar with the name Cosmont. We use them for
We use them for a lot. And they did do the $30 million lease revenue bond that we did for the harbor leases.
Yeah. Okay. All right. All right. So were there any public comments related to J1?
Sorry, there's no e-comments.
Okay.
Wanted to mention, just for the record, Commissioner Johnson is listening in through his phone, and he's watching the meeting through the city website. We have him indicated as unmuted, but he said that he's unable to contribute because I guess we can't hear him. So I want to apologize to him, and I just want to make it for the record, Stephen Johnson has been and is in attendance.
Thank you, Doug. All right.
Can't give Steve a hard time.
Okay. Any other discussion on this item internally within our group?
where do we,
I'm sorry, go ahead, Jerry.
Yeah, where do we go with this? I think it's a slam dunk that we need to push it and go forward with it. With this kind of payoff and the problem we're looking at in the future, there's just no reasonable way not to do it. We may have opposition to it, but someone mentioned a moment ago, I think, and I've heard this before, the one objection could be using one debt to handle another debt. I'd handle that quickly by saying, have you refinanced your mortgage lately? This is nothing more than refinancing your mortgage.
Absolutely. I don't see any valid criticisms to it, honestly.
I agree with Jerry. I think that an action item for us tonight would be to maybe put something together, and Marnie, if you could please give us some guidance on that, to make a recommendation as a council that we try and get this on the city council agenda, or send a note to them recommending that we have listened to this presentation and strongly recommend taking up some of the recommendations within the presentation. Maybe make a couple of observations. I'll leave it to the chair to decide how to proceed with that. But I agree with Jerry that we should have an action item here tonight.
The easiest way is for me to just relay to city management that you would like to proceed, and then we can work towards getting the presentation on the city council agenda. And at that time, you could chime in as a commission and say, yes, we agree with doing it.
Would we, what do you all think? Would we want to go ahead and make a recommendation and say we prefer the lease revenue bonds to the pension obligations, or the hybrid method? I think I agree with you, Jason, that the hybrid method seems to be a better option, or highlighting some of the things like they discussed, such as the predictable payment schedule, and recognizing that immediate savings, things that Jerry mentioned with regard to our savings and obligations, or simply just go ahead and say, yeah, we saw this presentation, we think you really ought to see this, and pick it up from there, not making any recommendation as to anything within the presentation we just saw.
I think the more important point to the city council is finding a way to get it on the agenda as quickly as possible. And I realize it's going to be horribly difficult with an election coming up, but it does sound like time is of the essence if we're going to do this. So I don't know how we stress getting it on the agenda sooner rather than later.
Yeah, the issue would be, I like someone's suggestion a moment ago of asking city council to watch the tape of this presentation tonight. That's the best way to get them keyed up on it, because if they see the option of $50 to $95 million savings over the next 20 to 30 years, that has a way of lighting some fires. So, but
yeah, I'm thinking about maybe, I like Marnie's idea about notifying staff and seeing what can be done to get it agendized that way, but no reason we can't do a two-pronged approach. We can even write a letter without Marnie's help. We don't need her to write a letter or draft a letter on our behalf. We can write one as a commission and submit it to them and let them know just that we had what we thought was a fantastic presentation. We encourage them to take a look at it, and without going into too much as far as our recommendations, we can kind of highlight some points like the potential savings over that period. What are your thoughts?
I think it'd be good to do on an individual basis, Jason. I don't know if we could all write a letter and then review it, and I think it would have to be just one of us, or no greater than three of us that did something like that.
Fair enough. Fair point. So why don't we do this? I'd be looking for a motion to establish a subcommittee to prepare a letter. I would say today's Thursday, by next Monday, that can be sent to, I can send it as a chairman on behalf of the commission. to send it to the city council members.
You wouldn't even have to form a subcommittee. You could use
Okay.
existing subcommittee.
I'm sorry, we could do what?
Use your existing subcommittee.
Oh, I got you.
'Cause
That's fine. That's fine with me.
It is CalPERS, it is partially CalPERS.
Well, yeah. All right. Well, let Jerry and Eugene, are you open to that?
Sure, yeah.
Yep.
Okay.
I'd like to say, sorry, go ahead, Jason.
No, I was just thinking, I could kick it off just to have a skeleton and send to you guys, and then you start, and then you could fix my work for me, okay, and make it much more presentable. But I don't mind kicking the ball, getting things going there. So let's do that.
I want to take a vote then to make sure that that's okay with everybody, that the subcommittee prepares and sends the letter.
Okay, do we need a motion then first before a vote? Okay,
Yep.
so looking for a motion to give the subcommittee the authority to write the letter on behalf of the commission relating to our impression of the pension obligation bond presentation.
Let me suggest this. We don't really have to just have the input of those three people. Why don't you go ahead and prepare that initial draft, send it to all of us. And
is that a Brown Act? I think that might be a Brown Act.
That would be Brown Act.
Yeah.
okay.
Yeah.
Okay.
So,
yeah.
so that's why the three of us can, pending approval of the rest of the commission, if they're comfortable with us kind of speaking on their behalf. That's the motion I'm looking for, and I'll just restate it more simply to say, looking for a motion to approve the CalPERS subcommittee to write a letter on behalf of the commission to council.
So moved.
I'll second that.
Okay, and then we'll do a roll call vote.
Can the subcommittee make the motion and second it themselves?
We just did.
Maybe not.
So
well, you still get to vote on it.
I'm sorry, my mute button was stuck and I was getting ready to make that motion. So
Okay, let me just to keep it clean. I'll withdraw my motion and you make it.
okay, I move that we do what Jerry said.
I'll second that.
All right, then we'll go with a quick roll call vote. Commissioner Wynn.
Aye.
Commissioner Samples.
Aye.
Commissioner Solomon.
Aye.
Commissioner Woodham.
Aye.
And I would ask Commissioner Johnson, but I understand we can't hear what he says. So
I'm on the phone.
oh, we can
There we
hear
go.
you. Welcome.
Yeah.
In that case, Commissioner Johnson, please.
I'm not happy with not being able to access these meetings for the last couple of months, but I vote no.
Fair enough. Commissioner votes aye.
And by the way, I'm not happy with not being able to see the presentations or participate for the past couple of months. And to repeat, I vote no.
Okay, we heard you the first time and the second time. So with what do we have? With a vote of 5-1, the motion passes.
Marnie, just to clarify, this would be in addition to what you recommended, where staff would approach or management to try and get this on the city council agenda as well. Yes.
Sure.
Okay. Thank you.
Now,
I also want
Steve,
to thank you, Marnie. This is something that obviously we've been talking about for a long time. CalPERS and how to handle these obligations. We created a subcommittee. And over the last few months, we've talked about this a lot. And I appreciate Commissioner Johnson's sentiment about not being able to participate in these things, but I'm glad that they're being brought forward, hoping that we can include him more on this part of it, to be certain. But glad that we're getting these presentations from CalPERS from Cosmont, from some of the other city resources to try and work to perform some function of helping the council come up with options to solve this problem. So thank you, Marnie.
Yes, I was going to save it for the end, but I wanted to thank you, Marnie, as well for putting, making this happen as quickly as you did. I know we've only been talking about these pension obligation bonds for a relatively short amount of time as a commission, and I think it's fantastic that we were able to get that presentation. I also wanted to briefly go back to Commissioner Johnson. I didn't want to sound abrupt with what I said earlier, and certainly you're.
I'm sorry. I'm gonna step in. You were incredibly abrupt.
Okay.
And if I do not gain access to these meetings, I will resign.
Okay. Again, I apologize if it came off abrupt. It was meant to be more of a lighthearted thing. Your opinions and consideration is greatly appreciated by me, and I'm sure the rest of the group. And
there's nothing lighthearted about it.
Okay.
I've been shut out 3 months in a row.
Why have you been shut out? I don't understand the issue.
I can't get into the Zoom meeting. I am on Zoom. I'm on Skype. I'm on Microsoft Teams. I'm on meetings 12 hours a day, but I'm not allowed into this meeting 3 months in a row.
What do you mean not allowed?
I get a message saying error, and I'm not going to repeat it. It's been reported via email for 3 months.
Okay. And I'm sure you tried different platforms like a phone and a PC, and you had the same problem with different platforms.
I am on the phone right now watching the public presentation.
Okay. Okay. I wish there was something we could do to help you. I mean, I know that we definitely appreciate your participation and contributions to our commission meetings. May I just ask you this, as far as it related to your no vote, was that because you feel like you weren't able to see the presentation and get a full understanding of it, or is there anything else that you'd like to share with us as to why you voted in the negative?
Without being able to see and participate, I couldn't give a full answer to that.
That's very fair.
I will echo what I've said in the past. The cavalierness of these decisions with such limited information is shocking to me.
All right. Well, thank you for that.
Well, Steve, I hope that you don't consider stepping down, or I understand your frustration. I hope that we can get this worked out because we do really want to have your input. I know, speak to myself, we really want to have your input.
I will publicly and in the press resign if I don't get access to this meeting next month.
Marnie, can you or Doug or someone refer Steve to the IT department and get this resolved?
But needs to be city clerk, but I definitely plan to check with city clerk and see what we can do. We'll definitely do a test before the meeting, so we're not down to just at the meeting and find out. So, but we'll work with city clerk.
Okay, thank you.
I am on virtual meetings from 6:30 till 8:00 p.m. on every platform, including Zoom, 6 days a week. But yet I can't access this commission meeting.
Wow. Well, I'm sorry to hear that. Hopefully by the next meeting, there'll be some solution. We certainly all want you to participate. You're a valued member of the commission for sure. Okay.
Thank you.
All right. All right. With that, I'm going to ask for a motion to receive and file item J1.
A motion to receive and file J1.
Second.
All right, we'll do a roll call vote. Commissioner Wynn?
Aye.
Commissioner Samples?
Aye.
Commissioner Solomon?
Aye.
Commissioner Woodham?
Aye.
Commissioner Johnson?
Aye.
Chair votes aye as well. Item J1 is now received and filed. Moving on to item J2, discussion and possible action regarding the self-insurance program fund presented by Marnie Rule.
Good evening. So I have very little in a report, but your agenda had a whole lot of numbers. So our third-party administrator provided a loss run to our Human Resources Department, and that was forwarded on to me for the time period of claims history that you had requested as a commission. And so I took that information and summarized it down, totaling it by department and by claim type. So you have the information in your packet, and I can attempt to answer any questions.
I've got a couple of quick questions, please, Marnie.
Uh-huh.
For these loss reports, they are based on, do they base them, do you know, on calendar years or fiscal years, or are they policy periods?
Policy periods.
Okay. I noticed in the reports, in some places, it has a subtext of where the incident took place. It might say the harbor, for example. Public Works, some of those losses talk about potholes, debris, things like that. When we look at these reports, is there an analysis done to help guide us with regard to Public Works? Is there an analysis done to guide us beyond what our consultant does, saying this street hasn't been slurried in X number of years, or this street hasn't been repaved in X number of years, to say we're experiencing a higher loss ratio on these streets or in this area, and therefore we're going to ask the council to prioritize a slurry or sidewalk repair or other capital improvement as necessary within that area?
As far as I know, not a periodic analysis or anything like that. Of course, our Public Works Department annually, I think it is, they do one type of study annually and a more comprehensive study every 3 years on the streets, giving their conditions and all that. And that is what they're using for the repaving. But that's done in a totally separate environment than from a risk management perspective.
So do we know, or is there a risk management analysis based on our claims for what needs to get fixed in the city, say for sidewalks beyond streets?
Not that I know of.
So other than,
Data didn't come with it.
Commissioner Johnson's talked about this, Commissioner Samples has talked about this, certain parts of the city with parts of sidewalks that are torn up or problematic, or root structure and things like that, beyond someone making complaints about it, they don't use any of the other data to determine what would be prioritized for repair. I know I'm just stating the same thing a different way. I just make sure I'm understanding it correctly.
That's my understanding.
Okay, do we have a method? Do you think we could do something like that?
I don't know, not from this data. There was more data here. Like I said, I summarized it some. This particular data, didn't have the claimant. It didn't have the address where the loss occurred. But I'm sure that, in order to take something to court, you have to have that information, but it just wasn't in the loss run data I received.
Okay. Looking through the data and seeing where our losses are happening, obviously our shock losses are in things like that you would expect from large liability claims associated with the police department, or large liability claims associated with traffic accidents and things like that. But slip and falls can be shock losses. And I would think that from a proactive standpoint, we would want to go ahead and say we could save money on claims if we did an analysis as to where we were experiencing slip and fall hazards beyond what the streets are. Where are our sidewalks problematic? Where do we have problems with the roof structure that are problematic? And those sorts of things can then be put into a CIP budget, and we're fixing up the streets and sidewalks for our residents. We're also reducing our liability exposures, and the greater or better ability we have to reduce our liability exposures, the better opportunity we have to reduce what we're going to pay for insurance. So if that was something that could be analyzed, I would think that it would be effective, efficient, and a cost saver for the city overall to identify problem areas. It's cheaper to fix something than it is to pay out on attorneys and claims, in my experience, and it's better for the residents as well. It improves the quality of life for everybody, especially people who are perhaps challenged with mobility and just generally speaking. So that's all the questions I had for these lost ones. Thank you, Marty.
All right. Are there any other questions or comments from commissioners related to item J2?
Well, I scanned through this before the meeting and scanning through it again. I'm not sure it tells us anything. First of all, with the scan that we have, you can't read the first, the left-hand edge of the pages. But it appears that things like, I can't make out what the heading is even. The first column has a whole bunch of things like normal boulevard and normal PD and normal bodily injury. That tells us absolutely nothing. I think it would be kind of nice if we saw this breakdown by department, as well as a little bit more detail of what it's, as I think Commissioner Solomon said, a little bit more detail of what this is actually about, because the descriptions that we have are really non-existent. So location, department, we need to cut this data a couple of different ways to even start to have a discussion. Does anybody else believe that, or am I off base?
I agree.
I don't think department's going to get you that much. Police or fire, it would. Public works, sometimes. Everybody else appears in their database to be combined.
Well, there's a whole bunch of stuff here that says public works. There are things that say like ADA violations. Have no idea what that's about. That probably has to do with public works.
And see, that's all that's listed. Another department is not listed. And some of these are hard to identify. I mean, it's a citywide issue, hard to identify with a department.
Well, things like location, as Commissioner Solomon said, and a breakdown by department, I think would give us a much better idea. I'm reasonably sure that the various department heads get an idea of what their costs of operations and insurance are. If we're going to provide any feedback to the city council or anyone else, we've got to look at more normalized data. And I'm appalled at the quality of what we've got here. So other than that,
Commissioner Samples, I would agree with you certainly to the extent that we've got department heads that are supposed to be responsible for their numbers, and if to Marnie's point, a lot of this are shared expense with not that aren't department specific, then who's watching that shop? You know, it's kind of like nobody's responsible for the commingled costs. So to the extent possible, we should be able to see it, not just us, but council and the department head should be able to see it at the department level.
yeah, I'm sorry, Marnie, but this just makes no sense to me. So I really can't comment on it. I would be.
I can't either. It's a risk management report that I subtotaled for you.
Okay, but things like, let's see, I don't even know which page this is. Page 57 of 59. Down the left-hand column, there's half a page that all says normal PD, whoever that is. And then in the department.
Property damage.
Okay, normal property damage. And then down the department, it's got police, public works, city hall departments. I guess all the city hall departments just fall into one lump sum?
Yes.
Okay. I don't know. If I had to do anything, I would make a motion that this report, that we not accept this report and we send it back to risk management and we get a better report.
And if that does go through, you know that I'm not able to commit to that. I can ask for it.
I get it.
If one exists, but I can't commit to, yes, you will be provided with a better report.
Yep.
I don't know, honestly, Commissioner Samples, if there's going to be a more detailed loss run, if there might be a different report that provides a level of data that you're looking for, but from a loss run perspective, it's pretty typical. But I agree with you that there are ways of there are ways of using a report like this that I alluded to a moment ago to help us improve our operational results.
Right.
You'll see when you go through the report, you can see patterns that establish problematic risk management within the city. So when you see a cluster of from 2017 and 2018, you've got a cluster of 5 claims in employment practices liability. That's an area then to go back and identify from a risk management standpoint, well, what's going on that we had a cluster of 5 claims for the same thing, all within a 1-year period.
Right.
Or if you look at a number of trip and falls, you see a lot of sidewalk trip and falls with public works. When you look through it, you say, well, okay, well, what's going on? Can we identify a subsection within the city where that's happening more than not, and identify that from a risk management standpoint and say, we need to improve our operations in this part of the city because it's costing us too much money in liability.
Right.
Or of traffic accidents, if you find a cluster or pattern that way. So from that perspective, I think the report's effective in pointing out patterns that we can improve our operational results. But until we get a better idea, a little bit more detail about, well, and there's some things we're limited by, certainly by human resources and privacy disclosures. You can't get into employment practices claims, but within management, they can identify and say, these were in this department. We had all of these claims. What's going on there? And address it. Or we had 15 sidewalk trip and fall claims this year. What neighborhood was that in? And address it. So if we found a report that would identify things that way, I think it would be helpful in more detail.
Yeah, I'm sorry, maybe I'm getting old. I can't make heads or tails of this report.
Marnie, was this report done or exported into Excel or a
Yes.
similar spreadsheet? Okay. because I'm wondering, maybe if we were able to get it in Excel format, this to me looks like it's begging to be put into a pivot table, you know, so that we can look at it by claim type rolled up or by department rolled up, things like that. And I think if we have the ability to do that, maybe it's going to provide more of the insight that Commissioner Samples is looking for without giving you a tremendous more amount of work to do. Is that an option?
I will have to find out.
Okay.
Thank you.
Okay. Any other questions or comments on item J2 from the commission? Do we have any public comments on this item?
No e-comments.
All right. Can I
And
get
no
any?
public to comment.
Thank you. Can I get a motion to receive and file item J2, please?
Motion to receive and file item J2 and ask if there is an available change in format that we be provided that copy.
Second.
All right, we'll do a roll call vote, beginning with Commissioner Wynn.
Aye.
Commissioner Samples.
Aye.
Commissioner Solomon.
Aye.
Commissioner Woodham.
Aye.
Commissioner Johnson. Okay. The chair votes aye as well. Item J2 is now received and filed. Moving on to item J3, discussion and possible action regarding CalPERS and Workers' Compensation Subcommittee report. I just wanted to, well, I'll kick it off on behalf of the subcommittee. I guess as chair, that's my, I can do that. We did not meet as a subcommittee this month, but we still had, there was still communication. In particular, there was an email that Commissioner Woodham wrote to Marnie. And if I ask everybody to go to page 22 of their agenda packet, because, is it 22? I may have misspoke. It's actually page, well, it's our J1 item. It kind of starts on page 20. Looking through this, well, stay with me. It's more so on page 21. But I just wanted to confirm, Marnie, can you please confirm this? This looks like this is in response to Commissioner Woodham's request.
It is.
Fantastic. So this, I kind of glossed over it because I was thinking of J1 as more of that presentation, which clearly there was a lot of that. But first of all, I want to thank you on behalf of the subcommittee for putting this together per the request. Jerry, if you want to speak to the request specifically, you can, but I would say basically you were requesting that we use or rather that staff use the CalPERS website and calculator to run scenarios that we were told about in our last meeting. And Marnie went in and did that. Jerry asked that she look at it based on a different discount rates or return assumption rates, return rate of returns at 6, 6 1/4, 6 1/2, and 6 3/4. And looking at this, it appears that you've done so. So Marnie, if you wouldn't mind, would you just maybe speak to the work that you did and what you came up with?
Yeah, so the default in the pension outlook tool is 7% discount rate, and then the default also has the actual earnings matching the discount rate. And so held that true and just changed the discount rate to the various scenarios. It then provides a spreadsheet, which is not pretty, so I tried to clean it up and make it a tiny bit more readable. And it leaves the current discount rate of 7% as your baseline, and does those same figures for the scenario that you've changed it to, and then provides an impact on the cost. And so there's a spreadsheet then for each scenario.
And it doesn't provide us with a graph, much like we saw in the presentation, even today's presentation with the UAL over time and how it continues to rise for roughly 10 or so years before it starts to trail off. Because in my mind, would be the ideal information to get, because that whole line is based on the 7%, which we have every expectation is going to come down. And when that comes down, our contribution goes up. That would be ideal to see the lines at different discount rates.
I can check and see. I don't recall.
Okay.
Yeah, that's what we were shooting for, is just to get an idea of what the total obligation of the city would be, the delta in that obligation each year if the assumed rate of return were.
Yeah, so the employer cost.
Right.
So,
is that the impact on UAL?
Like the 6%, the first few columns. So then you actually save 0.15 million in the first year. The costs increase by 9.11 million in the following year, 9.13 million, and so on. That impact on cost is the change.
So bear with me for a moment, if you will. If I'm looking at the very first page, page 22, the very first page of the data. So this shows at 6%, 7%, baseline 7%, 6% discount rate, and impact on UAL, very bottom line. So when I see 83.51, that's $83.51 million. Would I be interpreting that correctly to say our UAL would increase by that much more? And if so, what is that based on? What new discount rate? Would that be the 6% discount rate?
Yes. Right?
Okay.
Because you have your baseline, then your and
so we're saying
then the impact, the change.
Okay. So we're kind of calling that our worst case scenario. If when they meet, they come back and they say, instead of 7%, now we're going with 6%. Then if I'm reading this correctly, I would expect an increase in the city's contribution in the first year of 83.5 million and then 89 in the next year.
That down at the bottom, you're in like total UAL. The UAL balance, you have to go above to where the fiscal year, not the date is, and that impact on cost and the total employer cost. That's your increase or decrease.
Okay, so no change in the current year. I don't know how we possibly save money if they lower. Maybe let me just ask you that. How would we save money?
Well, 21, 22 isn't particular valuable anyways, like they were pointing out. We've already paid that.
Okay, fair enough. So if we knock out
don't want to start looking till 20.
That's fine. So if we knock out the first two columns completely and just start looking at it beyond that, we see that if it goes from 7% down to 6%, we should expect to spend or to contribute an additional roughly 9 million each year in UAL.
Yes.
Okay. Okay, very good.
Well, actually, it includes normal cost as well. So it's not just the UAL portion of our.
Okay. Well, let me put it a different way.
But it's the percentage amount as well.
Okay. So if it includes, I'm just trying to figure out what the marginal impact is of going from 7% to 6%. So if you're saying the 9.11 million in year 22-23 includes other things, what would I compare that? Is the normal cost
So
6.66? So is that what I'm comparing it to? Or,
So you would have to do your own math to break it into the components. But so if you're comparing 6.66 to 9.29, your normal cost is going to go up about 2.5 million.
$2.5 million. Okay,
And
so I
then
subtract
you're going-
those two to get the delta.
Yeah.
Okay. So the city would have to come up with an extra 2.5 million, let's just call it, per year. There would be an
On
additional.
normal cost plus your UAL payment would
Okay,
17 million to 23 million. And the total of those, your total PERS cost would go up $9 million.
okay. I'm sorry if I'm beating a dead horse here, but I feel like then that's where we started. When it looks at everything, the normal cost, the UAL payments, that the total impact on cost in year 22-23 is 9.11 million,
Yes.
meaning the total additional cost to the city is 9.11 million if the rate goes from 7 down to 6.
Yep.
Okay, that's what I thought. Okay. So to see that line, we could technically just add that amount to the existing line, right? To that,
Right.
That would be the difference. Okay, so that's at 6. So then I'm not going to, I promise you guys, I'm not going to look at each one of these. I just want to look at one other scenario. So maybe whatever's the next one on here. Is it 6.25? There we go. Okay, I got you. Then on page 26, we see that at 6.25, the total impact is 6.97 million, right?
Yep.
Okay. I just figured as long as you did all the work, we might as well have a good understanding of what it's telling us. And it's pretty much telling us what we would expect, right? As that rate comes down, the city needs to contribute more.
Yes.
Okay. Thank you very much for that. I'll leave it open to Eugene and Jerry if they want to speak on behalf of the subcommittee some more, but I think that was certainly the big item this month. And again, I want to thank Marnie for putting it together for us to look at.
One thing I'd like to ask about, Marnie, is since the subcommittee or part of it is related to the workers' compensation. In December, one of the city council meetings, there was a referral and a motion to discuss the appropriation to dive deeper into the firefighter worker comp numbers. And I know they voted to discuss it, not to appropriate the money, but to discuss to appropriate it. Do you know when or if that's going to appear on a January agenda?
Yes. The agenda that was created today for Tuesday's agenda, I was going to tomorrow send you all a copy of that report. It's really just your letter.
Oh, it's the letter asking, that's the chair asking to expend these funds for a deeper dive.
Yep.
Okay, great. Thank you. So that'll be on, you said Tuesday night?
Yep.
Okay, thank you, Marnie. That's all I have. Thank you.
All right. Any questions or comments on the subcommittee report or the work Marnie did? Anybody else? Okay. Seeing no other comments or questions, I will ask for a motion to receive and file item J3.
Motion to receive and file J3.
Second.
All right, and a roll call vote, beginning with Commissioner Wynn, please.
Aye.
Commissioner Samples?
Aye.
Commissioner Solomon?
Aye.
Commissioner Woodham?
Aye.
And the chair votes aye as well. Item J3 is now received and filed. Okay. next on the agenda, item K. We'll move on to member items and referrals for staff. I'd like to begin with Commissioner Woodham.
I have none. Thank you.
All right. Commissioner Solomon.
Yes, that's something we discussed at the very beginning of the meeting. Marnie, is there a way that we could find out if Redondo has some representation, or the COG or South Bay Council of Governments, who our representation is with the CalPERS board, where we could approach that person or persons for some of these questions that we have that come up?
How I was going to approach it is to let you know the makeup of the CalPERS board and how those members basically come to be.
Okay, that's great. Thank you for doing that. That's each of us as individuals or as a group can weigh in on how we want to approach contributing information to the board or asking the city council to do so.
Yeah, I don't think it's regional or anything like that. I think everything is statewide.
Okay, I'm sure it's statewide. I just wondered if, let's say, and thank you for doing that. It'll be where this member of the COG is on the board, or is the person that's the contact. Thank you.
All right. Commissioner Wynn.
I think the only thing referral is, I just want to reiterate, we need to get Commissioner Johnson's account up and running. I don't know what's going on, but it's been 3 months, so I'll just reiterate that. But besides that, I think it was a great presentation tonight. Cosmon, I think, did a great job of simplifying it. Some of these presentations come and it seems really confusing, but these guys kept it very simple, so they did a great job. That's it for me.
Thank you. Yeah, I wanted to reiterate. I was going to say to my portion, but about Commissioner Johnson, whatever the city can do to help make that happen would be appreciated by all. Okay, and Commissioner Samples?
I have nothing.
All right, I had a couple different things. Most of them were covered throughout the meeting, which is fantastic. So at this point, the only other thing I have left, and it's not, well, is that I'd like to ask fellow commissioners if there's any items or discussion earlier in the meeting that you, in tonight's meeting, that you would like to see on next month's agenda, so we can just memorialize it if there is something.
Just to make sure you notice the calendar next.
Yes, it's
one of those quarterly months, and it's a very full.
It's a full month. It's a full month, and I understand that. I certainly appreciate your time involved with that. But I wanted to weigh that against if there's something that somebody feels like it needs to be talked about. I just don't want anyone to feel like things are just, like getting kicked down the road, but not ever actually being discussed as an agendized item. And there might not be anything. I don't personally have anything, but I just want to give the commissioners here the opportunity to bring up anything if there is. Seeing nothing. Okay, seeing nothing. Then that should do it. With no other items, I will entertain a motion to adjourn.
So moved.
Second.
All right. Seeing a motion and a second, we will do our last roll call vote of the night, beginning with Commissioner Wynn.
Aye.
Commissioner Samples.
Aye.
Commissioner Solomon.
Aye.
And Commissioner Woodham.
Aye.
Chair votes aye as well. I'd like to thank you, Marnie, Eleanor, Doug, Tammy, and fellow commissioners. Have a good evening, and we'll see you again in February.
Thank you.
Thank you. Good night,
Thank you.
everyone.
Bye, everybody.
Solid.